committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time, and all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. This hearing is for the purpose of receiving the semi-annual testimony of the chair of the Board of Governors of the Federal Reserve System on monetary policy and the state of the economy. I now recognize myself for 3.5 minutes to give an opening statement. As we meet today, thanks to the fiscal policies of the Trump administration and this Congress, many Americans are seeing the strongest economy of their lifetimes. Most importantly, 3% average economic growth is back. 90% of Americans are seeing bigger paychecks, and in the last quarter, real disposable income increased a very strong 3.4%, and unemployment remains near a 50-year low. But the economy may be challenged in significant ways if either we find ourselves in a protracted global trade war or the unconventional monetary policy tools of the Fed are not carefully and skillfully wound down and transitioned to normalcy. In February, during our last Humphrey Hawkins hearing, I questioned whether the Fed would ever return to a monetary policy balance sheet after a decade of accumulating and maintaining, in contrast, a macro-prudential balance sheet, and my concern remains because less than a year into the Fed's balance sheet wind down, some FOMC members are already calling to slow down or end the process. We were told by the Fed that letting the roll-off schedule run for 3 or 4 years would be less exciting than watching paint dry. But as we meet today, we face the prospect that maybe the paint stays wet. In other words, we seem to be faced with an increasing prospect of a balance sheet that may never return to a more conventional size or composition. I believe this is problematic. An unconventional balance sheet may well threaten, ultimately, the integrity and independence of the Fed's conduct of monetary policy by enabling competing activities that lie outside its mandate for stable prices and full employment. This matter must be reviewed carefully. Additionally, I have governance concerns. I would note today that only 3 individuals, as a practical matter, are actually empowered to set U.S. monetary policy. This is a matter of concern. We know that interest rates on reserve deposits have now supplanted open market operations of the FOMC and playing the lead role in conducting monetary policy. Given that the Board of Governors can administer interest rates on reserve deposits without any input from the FOMC or any district bank president. This means 3 individuals, or to be more precise, 2 given a majority vote, set monetary policy in the U.S. I certainly don't believe this is currently being abused, but I do believe, as a matter of public policy, the full FOMC should vote on where to set interest rates on reserve deposits. And furthermore, I would call upon the Senate to expeditiously confirm the Federal Reserve Board governors that the President has long since nominated. Finally, many members, including myself, share a concern about the apparent inconsistency of a 2% inflation target with the goal of price stability. 2% inflation target means that every dollar a couple sets aside at a child's birth for her college education will have lost approximately 30% of its purchasing power by the time the first tuition bill arrives. I understand that other central banks do this. I understand this may be good policy, but if so, Congress should decide this, because Section 2A of the Federal Reserve Act mandates, quote, stable prices. And last I looked up the word stable in the dictionary, it means, quote, unquote, fixed, quote, unquote, not changing, or, quote, unquote, permanent. And yet we see even some advocating a policy rate target that allows for even greater swings than the current 2% inflation target. Chairman Powell, we welcome you, and we look forward to hearing more about these issues, and we look forward to a prudent path to normalization where interest rates are once again market-based and credit is allocated to its most efficient use. I now recognize the ranking member of the committee, the gentlelady from California, for 3 minutes for an opening statement.
Thank you, Mr. Chairman, and welcome, Chairman Powell. Mr. Chairman, I'm very concerned about the impact of the reckless economic policies of Donald Trump on hardworking Americans, vulnerable families, and our nation's economy. This president has started a trade war that is already harming American consumers and companies. For example, Whirlpool, based in Michigan, has seen its share price drop over 15% as a result of Trump's tariffs on steel and aluminum. Washing machines and dryer prices have increased 20%. According to the Wall Street Journal, the mayor of Clyde, Ohio, where Whirlpool has a plant, commented on the tariffs saying, I quote, "People's anxiety level is higher because nobody knows what's going on," quote unquote. The tax scam that the congressional Republicans and President Trump pushed through explodes the deficit and raises taxes on 86 million American families to help out big corporations and very wealthy individuals. But most of these corporations are not using the windfall to pay better wages to their employees. Instead, they're buying back their own stock to boost share prices and enrich their CEOs. And in the end, this massive, misguided giveaway will be paid for by future generations of taxpayers. In addition, the Trump administration's latest budget proposal makes deep cuts to important health care, nutritional assistance, housing and community development programs, and would be detrimental to families, veterans, seniors, and persons with disabilities. In all, the Trump administration's policies are deeply harmful and threaten the hard-earned economic gains put in motion during the Obama administration. As a result of Democratic policies and the policies of the Federal Reserve, we are now experiencing the longest stretch of private sector job growth on record. But with these harmful economic policies, Trump is putting all of that progress at risk. So I'm very interested in Chairman Powell's views on these matters, especially the long-term effect of Trump's damaging economic policies and what tools, if any, the Federal Reserve has to prevent a possible recession that could be triggered by the policies of this administration. With that, I yield back the balance of my time.
Gentlelady yields back. The chair now recognizes the gentleman from Kentucky, Mr. Barr, the chairman of the Monetary Policy and Trade Subcommittee, for 1.5 minutes.
Thank you, Mr. Chairman. And Chairman Powell, thank you for testifying today. As Chairman Hensarling has already stated, the economy is strong and the data support this statement. Americans have more money in their paychecks thanks to tax reform. Job creation is strong. Unemployment is near a 50-year low. And many Americans who left the workforce during the financial crisis are re-entering it. While overall, the economic outlook of America is bright, there are a few items that we need to carefully watch. One is uncertainty surrounding U.S. trade policy, which impacts key Kentucky industries such as bourbon, agriculture, and auto manufacturing. Another is the legacy of the Fed's unconventional monetary policies and bloated asset sheet that continues to distort credit allocation. A third is a flattening yield curve that some economists warn could signal a downturn. And a final risk is out-of-date regulation, such as the GSIB surcharge calculation that puts American banks at a disadvantage relative to their international competitors. Chairman Powell, thank you for your service at the Federal Reserve, and I look forward to hearing from you today about these and other important topics. I yield back.
Gentleman yields back. The chair now recognizes the gentlelady from Wisconsin, Ms. Moore, the ranking member of the Monetary Policy and Trade Subcommittee, for 1 minute.
Thank you so much, Mr. Chairman. And Mr. Chairman, it's lovely to see you again. I'm going to paraphrase and channel Ben Franklin here. Dodd-Frank gave America a stable economic system if we can keep it. I fear your greatest challenges in the future will be directly related to the actions of Republican policymakers and our president. Ruinous trickle-down tax cuts, adopting their policies that drive debt and income inequality, and of course the Wells Fargo model to saddle regular Americans with forced-place payday loans to pay it all back. Destabilizing financial deregulation and unqualified nominees like Kathy Kraninger to head the Consumer Financial Protection Bureau. Capricious trade wars Harley in my district, farmers in my state bracing for ruin, fiscal mismanagement, low-grade scams, and incompetence all seems to be hallmarks of Mr. Trump. But you know, as we discussed Esther 4:14, you have been called for such a time as this. God bless you.
Gentlelady yields back. Chair now recognizes the gentleman from Michigan, Mr. Kildee, the vice-ranking member, for 1 minute.
Thank you, Mr. Chairman, for yielding, and Chairman Powell, thank you for being here. I lead an initiative in Congress entitled The Future of America's Cities and Towns. Its purpose is to fuel a national conversation around the economic health of our country's older industrial cities and towns, places like my hometown of Flint that have not fully recovered from the Great Recession. Even with the job growth and economic recovery we've seen, it's uneven. In economic terms, there is no average American anymore. A whole cohort of communities across the country continue to experience the kind of stress that threatens their sustainability as communities and the fiscal solvency of their municipalities. I believe we have to have a much more serious and thoughtful conversation about how we support these places and the millions of people who live there. Many of the regional banks, such as the Boston, Cleveland, and Chicago banks, have taken an interest in working to improve the fiscal health of these places within their jurisdiction. And so I would be interested in hearing your thoughts on how the Fed can help these places. Monetary policy is by nature a broad tool for economic growth, but we must have a particular focus on creating more economic opportunity for those families and those communities that continue to struggle. Thank you, Mr. Chairman, for your indulgence.
If that's how you interpret indulgence.
You didn't cut me off.
Today, we welcome back to the committee for his second appearance, Governor Powell, Chairman of the Board of the Governors of the Federal Reserve System. Governor Powell has previously testified for this committee, so I believe he needs no further introduction. Without objection, the witness's written statement will be made part of the record. Chairman Powell, you are now recognized for your testimony. Welcome.
Thank you very much, and good morning, Chairman Henseling, Ranking Member Waters, and other members of the committee here today. I'm happy to present the Federal Reserve's semi-annual monetary policy report to Congress. And let me start by saying that my colleagues and I strongly support the goals that Congress has set for us for monetary policy, maximum employment and price stability. We also support clear and open communication about the policies we undertake to achieve these goals. We owe you and the general public clear explanations of what we are doing and why we're doing it. Monetary policy affects everyone and should be a mystery to no one. For the past 3 years, we have been gradually returning interest rates and the Fed's securities holdings to more normal levels as the economy strengthens. And we believe this is the best way we can help set conditions in which Americans who want a job can find one and in which inflation remains low and stable. I will review the current economic situation and outlook and then turn to monetary policy. Since I last testified here in February, the job market has continued to strengthen and inflation has moved up. In the most recent data, inflation was a little above 2%, the level that the Federal Open Market Committee thinks will best achieve our price stability and employment objectives over the longer run. The latest figure was boosted by a significant increase in gasoline and other energy prices. An average of 215,000 net new jobs were created each month this year in the first half of the year. That number is somewhat higher than the monthly average for 2017. It's also a good deal higher than the average number of people who enter the workforce each month on net. The unemployment rate edged down 0.1% over the first half of the year to 4.0% in June, which is near the lowest level of the past 2 decades. In addition, the share of the population that either has a job or has looked for one in the past month, what we call the labor force participation rate, has not changed much since late 2013, and this development is another sign of labor market strength. Part of what has kept that participation rate stable is that more working-age people have started looking for a job, which has helped make up for the large number of baby boomers who are retiring and leaving the workforce. Another piece of good news is that the robust conditions in the labor market are being felt by many different groups. For example, the unemployment rates for African Americans and Hispanics have fallen sharply over the past few years and are now near their lowest levels since the Bureau of Labor Statistics began reporting data for these groups in 1972. Groups with higher unemployment rates have tended to benefit the most as the job market has strengthened. But jobless rates for these groups are still higher than those for whites, and while 3/4 of whites responded in a recent Federal Reserve survey that they were doing at least okay financially in 2017, only 2/3 of African Americans and Hispanics responded that way. Incoming data show that, alongside the strong job market, the U.S. economy has grown at a solid pace so far this year. The value of goods and services produced in the economy, or GDP, rose at a moderate annual rate of 2% in the first quarter after adjusting for inflation. However, the latest data suggests that economic growth in the second quarter was considerably stronger than in the first. And this solid pace of growth so far this year is based on several factors. Robust job gains, rising after-tax incomes, and optimism among households have lifted consumer spending in recent months. Investment by businesses has continued to grow at a healthy rate. Good economic performance in other countries has supported U.S. exports and manufacturing. And while housing construction has not increased this year, it is up noticeably from where it stood a few years ago. I'll turn now to inflation. After several years in which inflation ran below our 2% objective, the recent data are encouraging. The price index for personal consumption expenditures, or PCE inflation as we call it, which is an overall measure of prices paid by consumers, increased 2.3% over the 12 months ending in May, and that number is up from 1.5% a year ago. Overall inflation increased partly because of higher oil prices, which caused a sharp rise in gasoline and other energy prices paid by consumers. Because energy prices move up and down a great deal, we also look at core inflation. Core inflation excludes energy and food prices and is generally a better indicator of future overall inflation. Core inflation was 2.0% for the 12 months ending in May, compared with 1.5% a year ago. We will continue to keep a close eye on inflation with a goal of keeping it near 2%. Looking ahead, my colleagues on the FOMC and I expect that with appropriate monetary policy, the job market will remain strong and inflation will stay near 2% over the next several years. This judgment reflects several factors. First, interest rates and financial conditions more broadly remain favorable to growth. Second, our financial system is much stronger than before the crisis and is in a good position to meet the credit needs of households and businesses. Third, federal tax and spending policies will likely continue to support the expansion. And fourth, the outlook for economic growth abroad remains solid, despite greater uncertainties in several parts of the world. Now, what I have just described is what we see as the most likely path for the economy. Of course, economic outcomes that we actually experience often turn out to be a good deal stronger or weaker than those in our best forecast. For example, it is difficult to predict the ultimate outcome of current discussions over trade policy, as well as the size and timing of economic effects of the recent changes in fiscal policy. Overall, we see the risk of the economy unexpectedly weakening as roughly balanced with the possibility of the economy growing faster than we currently anticipate. Over the first half of 2018, the FOMC has continued to gradually reduce monetary policy accommodation. In other words, we've continued to dial back the extra boost that was needed to help the economy recover from the financial crisis and the recession. Specifically, we raised the target range for the federal funds rate by 1/4 percentage point at both our March and June meetings, bringing the target today to its current range of 1.75% to 2%. In addition, last October, we started gradually reducing our holdings of Treasury and mortgage-backed securities, and that process has been running quite smoothly. Our policies reflect the strong performance of the economy and are intended to help make sure that that continues. The payment of interest on balances held by banks in their accounts at the Federal Reserve has played a key role in carrying out these policies, as the current monetary policy report explains in some detail. Payment of interest on these balances is our principal tool for keeping the federal funds rate in the FOMC's target rate range. This tool has made it possible for us to gradually return interest rates to a more normal level without disrupting financial markets and the economy. As I mentioned, after many years of running below target, our longer-run objective of 2% inflation has recently moved close to that level, and our challenge will be to keep it there. Many factors affect inflation. Some of them are temporary and others longer-lasting. Inflation will at times be above 2%, at other times below. And we say that the 2% objective is symmetric because the FOMC would be concerned if inflation were running persistently above or below that 2% objective. The unemployment rate is low and expected to fall further. Americans who want jobs have a good chance of finding them. Moreover, wages are growing a little faster than they did a few years ago. That said, they're still not rising as fast as in the years before the crisis. One explanation could be that productivity growth has been low in recent years. On a brighter note, though, moderate wage growth also tells us that the job market is not causing high inflation. With a strong job market, inflation close to our objective, and the risks to the outlook roughly balanced, the FOMC believes that for now, the best way forward is to keep gradually raising the federal funds rate. We are aware that, on the one hand, raising interest rates too slowly may lead to high inflation or financial market excesses. On the other hand, if we raise rates too rapidly, the economy could weaken and inflation could persistently run below our objective. The committee will continue to weigh a wide range of relevant information when deciding what monetary policy will be appropriate. As always, our actions will depend on the economic outlook, which may change as we receive new data. For guideposts on appropriate policy, the FOMC routinely looks at monetary policy rules that recommend a level for the federal funds rate based on the current rates of inflation and employment. The July Monetary Policy Report gives an update on monetary policy rules and their role in our policy discussions. I continue to find these rules helpful, although using them requires careful judgment. Thank you very much, and I will look forward to our conversations.
Thank you, Chairman Powell. The chair now yields to himself 5 minutes for questions. I don't believe, Chairman Powell, there was a discussion about this on the Senate side yesterday. I didn't hear much about it in your testimony. But I would still seek greater specificity on the current goals for the wind down of the balance sheet. It is my current understanding, again, that it is the goal with respect to the pace that this wind down will take about 3 to 4 years, that ultimately the size of the balance sheet as of today, the target is $2 to $2.5 trillion, and with respect to composition, primarily treasuries, but some MBS. Is my understanding correct? Is that the current goal of the Fed? And I'm sorry, if you could pull the microphone a little closer to you, Chairman.
How's that? Okay.
Much better, thank you.
So the plan is to return the balance sheet over time to a mainly Treasuries balance sheet. I've provided estimates, others have provided estimates of how long that will take. They're fairly uncertain, but my estimate has been 3 or 4 years. What will guide the time at which we will ultimately stop shrinking the balance sheet will really be a function, and the ultimate size of the balance sheet will really be a function of the public's demand for our liabilities. During quantitative easing, that was really about assets. In the long run, what matters is the public's demand for currency, which has grown very strongly for the last few years, and also the public's demand for reserves. And in an era where we require the banks to have lots of high-quality liquid assets, reserves are the ultimate high-quality liquid assets. So I think we're going to be finding out how big that demand is for those two liabilities and also some others. And I think there are estimates. We don't have a target range, for example. It's not the.
Okay, so you really don't know. Obviously,
right.
we all acknowledge there will be a greater demand for reserves, but I still would anticipate that in the $2 to $2.5 trillion, that might actually exceed demand. So I guess, Chairman Powell, my next question is it a goal of the Fed? So I understand you want to keep IOER, that you, particularly today, this is how monetary policy is determined. But do you see a day, is it the goal of the Federal Reserve to, again, have open market operations, the FOMC, primarily drive monetary policy? So I guess this is really the debate between kind of the floor and the corridor. Currently, we are using the floor, but is that the ultimate goal? Is this a permanent tool, or will we see a future where IOER sets the floor, the FOMC sets the higher end, and let the market determine the interest rate in between that floor and ceiling? What is the goal of the Fed?
The committee has not made a decision on whether in the longer run we'll go back to a corridor system or stay in what we have now, which is a floor system. And
when might the Fed contemplate this?
We'll be returning to that question, I'd say, fairly soon. It's something we've talked about periodically at various FOMC meetings, and my thinking is that we will return to it return to that discussion in a serious way in the relatively near future.
Well, one thing I would have you consider, Chairman Powell, as the Board of Governors takes a look at this, is ultimately the potential risk to the Fed's independence of having such an unconventional sized balance sheet. As you know, I would say regrettably, Congress rated a relatively small fund of the Federal Reserve to fund a transportation bill. I tried to fight that. I wasn't successful. It's been rated twice, so I've joined in with my colleagues. We also know now that the Fed funds the Bureau of Consumer Financial Protection. Both of these have nothing to do with monetary policy. I could foresee a day with a large balance sheet out there, and with the potential of either municipalities of states on the brink of insolvency, having Congress decide the Fed needs to buy their bonds and prop them up. I can also see one day an infrastructure bill coming down the pike. No good way to pay for it. There's a big pot of money that the Fed has. Maybe the Fed should be directed to buy these bonds. And I think we're seeing some of this, frankly, across the pond. When I look at the Swiss Central Bank or the ECB. So I'm just curious, as you think about the size of your balance sheet, do you ever consider its impact on your independence?
We do think about those things, and we've said that the balance sheet will return to a size that's no larger than it needs to be for us to affect monetary policy in our chosen framework.
Well, I just assure you, Mr. Chairman, if there's a big pot of money out there, this Congress might find a way to get its hands on it, so you might consider that as you consider the size of your balance sheet. Time of the chair has long since expired. The chair now recognizes the ranking member.
Thank you, Mr. Chairman. Chair Powell, while I've heard you state repeatedly that it is too soon to tell whether the economic efforts of the recent implementation of tariffs will be either positive or negative, there are already serious indications that we are headed for trouble. In the most recent June FOMAC meeting minutes, several participants noted that their district business contacts had expressed concern about the adverse effects of tariffs and other proposed trade restrictions on future investment activity, and that they were not planning any new investments to increase capacity. Mid-Continental Nail, America's largest nail manufacturer, based in Missouri, has already laid off 60 workers and expects to go out of business by Labor Day. Harley-Davidson, based in Wisconsin, is moving jobs overseas to Europe to avoid tariffs on its exports. Whirlpool, based in Michigan, has seen its share price drop over 15% as a result of Trump's tariffs on steel and aluminum. Washing machine and dryer prices have increased 20% in the past 3 months as a result, the steepest rise in the past 12 years, according to the Department of Labor. These tariffs are affecting the price of everything from bicycles to washers to automobiles. In addition to these immediate effects, to your point, there may be delayed negative effect on the economy as well. While the U.S. is taking a protectionist stance toward trade policy, the rest of the world is moving forward on trade without us. What long-term economic effects can we expect to see if these tariffs continue to escalate to the point of a trade war? Do you expect the economic effects of a trade war to be felt more acutely in certain regions of the U.S.? And furthermore, if the Fed is it well-suited to respond to a recession caused by a trade war? If not, what can be done?
I should start by quickly reminding all of us, including me, that we stay in our lane at the Fed, and when we talk about things like fiscal policy and trade policy that are not assigned to us, we try to stay at a high level, at principal level. But answering your question, if this process leads to a world of higher tariffs on a wide range of goods and services that are traded, and those are sustained for a longer period of time, in other words, if it results in a more protectionist world, that'll be bad for our economy. And it'll be bad for other economies, too. It'll be bad for the world economy. That is not what the administration says they're trying to achieve, and again, it isn't up to us to criticize their policies in this activity. But, you know, the evidence is clear that countries that remain open to trade have higher productivity, they have higher incomes. Not every group is affected positively by trade. There are groups that are hurt by trade, and I think all countries have learned that they need to do a better job of addressing the needs of those populations, but not through trade barriers and tariffs of that kind of thing.
While certainly the feds do not have direct responsibility for trade and for tariffs, are you consulted at all when the tariff decisions were made?
No, we play no role in the administration's discussions on these. Like I imagine just about everyone here, we hear from our extensive network of business contacts a rising chorus of concern. As you pointed out, lots and lots of individual companies have been harmed by this. We don't see it in the aggregate numbers yet because it's a $20 trillion economy and these things take time to show up, but we hear many, many stories of companies that are concerned and now beginning to make investment decisions or not make them because of this.
Have you had any action at all in relationship to the Chamber of Commerce? Have they talked with you? Have they sought your opinion? Have you talked with them? What do you know about the Chamber of Commerce position on tariffs?
Well, I saw that they took a very strong public position against tariffs. We have, you know, try to have good relations and strong relations with the Chamber. I haven't personally discussed their position on trade, but I know what it is.
Do you know what specifically they were concerned about as it relates to tariffs, any particular part of the country, agriculture, et cetera?
I shouldn't speak for them, but I think it's really a general thing. I mean, the bottom line is a more protectionist economy is economy that's less competitive, it's less productive. We know that. This is the torch we've been carrying around the world for 75 years. So it's not a good thing if that's where this goes. We don't know ultimately yet where this process will lead. The administration says they want lower tariffs, and that I think would be good for the economy if we achieve that.
Well, thank you very much, and I yield back the balance of my time.
Gentlelady yields back. The chair now recognizes the gentleman from Kentucky, Mr. Barr, chair of our Monetary Policy and Trade Subcommittee.
Thank you, Mr. Chairman. And Chairman Powell, welcome back to the committee. As you know, some economists argue that a flattening of the yield curve is an indication that an economy is headed for a recession. Obviously, with the strong data that we're seeing, we don't see any kind of indication of a recession in the near term. But I asked you this question 6 months ago in your last report, and I asked you, given the flattening of the yield curve and the risk potentially that short-term rates might exceed long-term rates, whether there would be any plans within the normalization strategy to accelerate the roll-off of longer-term assets more quickly to counteract the flattening of the yield curve. I believe you indicated that there were no such plans 6 months ago. I just wanted to ask you, given the fact that that yield curve has flattened even further in the interim since we last met, is there any discussion within the FOMC to alter or accelerate the balance sheet reduction program in contemplation of this flattening yield curve?
Thank you. No, there's not. You know, we very carefully developed and socialized to the public the balance sheet normalization plan. It's working smoothly. We're not thinking really about changing it, except in the conditions that we've identified, which would be, you know, a meaningful downturn.
Yeah. If that's the case, what is the Fed's plans with respect to that flattening yield curve, and what risks does that pose to the economy?
Maybe let me tell you how I think about the yield curve. So I think we know why the short end of the yield curve is moving up. It's because essentially out to 2 years or so, really the market is pricing in its expectations of what the Fed will do, plus or minus maybe a little bit of a term premium when you get out to 2 years. So we know why the short end is moving up. The real question is, what's the story with long rates? So the long rate, like take the 10-year Treasury, you have to decompose that and ask what's in it. And I think the whole point of the yield curve conversation is that you can decompose that, and in that whatever the long-term rate is, 2.85%, I guess this morning, the 10-year. What's in there is a term premium, but there's also sort of the market's estimate of the long-run neutral rate. And so it's telling you something, and we're listening, but it involves many other things. You've got to kind of do a decomposition to pull that out, and then that tells you what the stance of monetary policy is. So, you know, whether policy is accommodative or whether it's restrictive, and that is the important question, not the shape of the yield curve.
Chairman, would you agree that the oversized balance sheet is putting downward pressure on those long-term interest rates, continues to put downward pressure?
Yes, but to a diminishing degree.
Let me switch gears to IOER. For decades now, the Board of Governors has administered interest rates on reserves not for the intended purpose of fairly compensating commercial banks for required deposits at Federal Reserve banks, but rather as a monetary policy rate. Given the fact that IOER is now your principal tool for interest rate setting, would it not be better if IOER was set by the FOMC, a much more diverse body that includes not only the governors, but also the 5 voting district bank presidents, as opposed to just the Board of Governors? I
guess I think of it this way. The FOMC sets the target range for the federal funds rate. IOER is just a tool to make sure that the federal funds rate trades in the range that has been set by the FOMC. So it's really just a tool to follow through on the much more important decision, which is made by the FOMC.
Well, thank you. And as you know, and as we've discussed, this committee and the Congress is considering a proposal to transfer that responsibility of IOER to the FOMC, the larger, more diverse group, and we continue to engage you on that. Let me finally conclude with a question about trade. I agree with your assessment that free trade and low tariffs result in better economic performance as opposed to a trade war or high tariffs. How important is it for the administration to quickly resolve its trade and tariff negotiations, and what are the risks of a protracted period of increasing tariffs?
Again, wanting not to be an advisor or in any way a participant in these discussions, which are really up to the administration. Uncertainty, is one of those things where businesses, there's a lot of momentum in the economy earlier this year. I wouldn't want to see uncertainty lead people to start putting off decisions and that kind of thing. And that would be the risk of a long, protracted discussion.
Thank you for your answers. I yield back.
Time of the gentleman has expired. The chair now recognizes the gentlelady from Wisconsin, Ms. Moore, ranking member of the Monetary Policy and Trade Subcommittee.
Thank you so much, Mr. Chairman, and again, welcome back, Mr. Chairman. You talk a lot about productivity, and indeed, economists keep talking about an aging population, the boomers, then that's impacting productivity, and how lagging productivity is an ongoing drag on economic growth. I am wondering if you think that having a comprehensive immigration policy would help increase productivity.
Immigration is another one of those policies that's high up on the list of things that are not assigned to us, but I can still, so I'm going to try to stay in our lane. But I do think, to the extent these issues connect to the health of the economy in the long run, then we have an obligation to speak to that. So If you think about potential growth in the United States, you can really boil it down to how fast is the labor force growing, and how much is output per hour growing. That's it. That's all you have, right?
And
So,
our CRS does anticipate that over the next decade or so, it could increase our economy by $1 trillion to get these people out of the shadows. You talk in your remarks about the lower unemployment rates for African Americans and Hispanics. That's something we're all celebrating. But I swear to you, I know a lot of African Americans that are related to them. I don't know many that don't have 2 jobs in order to make it. I know some who have bachelor's degrees, and yet they're forced to live with roommates because they can't sustain themselves. So what we have found is that while there might be lower unemployment, wages have actually decreased. Despite the tax cuts, which claimed that there were going to be $4,000 for everybody, or we know we got these one-time only bonuses, wages have decreased, and income inequality has increased. And I'm wondering what your projection is for flat or lowered wages despite increased unemployment.
We look at a wide range of wage and compensation indicators, and pretty consistently across the board, if you look back at where they were 5 years ago and look back where they are now, they've all moved up. They used to be right around 2% increase per year. Now they're around 3%. We think this is a good thing.
African Americans, their wages are increasing?
Yes, I mean, I think it's pretty broad at this point in different.
And I would surely like to see these data because other economists have said that it's actually decreased. All right, thank you. I am wondering, I know you aren't going to ask any questions about the tax cuts, so I'll let you off. I am wondering, though, about the big tax cut. I've got to ask. The big tax cut that we just provided, and it's increased income inequality. I am just wondering what your thoughts are and projections about how sustainable that is when 80% of these tax cuts have gone for shareholder-type buybacks versus increase in wages or capital improvements. I'm wondering what you think for the going forward, what impact that'll have on economic growth.
I think that the U.S. fiscal policy has been on an unsustainable path for some time. It continues to be unsustainable.
Higher debt?
Yeah, I mean, the debt's going up, and I think it's growing faster than the economy. We need to get the economy growing faster than the debt. It comes down to that, and we're not doing that. It's something we should be working on now. We should all be working on that together.
I mean, do you think that, shareholder buybacks is a healthy indicator of healthy prospect for growth?
I think when a company decides to buy back stock, they're saying that we have more cash than we can put to work for our shareholders. That's kind of the capital markets working. That money doesn't go away. Of course, it goes into people who then can spend it or other.
And I mean, this is more money for them to use to chase yield. I mean, don't you think that the chasing of yield creates bubbles, and that's one of the big problems that we had in 2008? Just money chasing yield?
I think we certainly can find ourselves in a situation where we're seeing financial bubbles and that kind of thing. We watch that very closely. Don't see that now, but it's a key risk that we monitor very carefully.
And I thank you so much, sir.
Thank you.
Time of the gentlelady has expired. The chair now recognizes the gentleman from Missouri, Mr. Lukemeyer, chairman of our Financial Institutions Subcommittee.
Thank you, Mr. Chairman, and welcome, Chairman Powell. Yesterday we had a hearing with our Financial Institutions Subcommittee, and I asked the question of Acting Comptroller of the Currency, Keith Norica, about the implementation of Senate Bill 2155, and specifically whether or not the statutory language around the $250 billion threshold for SIFI designation was clear. Mr. Norica said that the language and congressional intent was pretty straightforward. And so my question to you is, would you agree with your former colleague that the language is pretty clear, no ambiguity there, that you know exactly what should be done with those banks under 250 with regards to SIFI activity and testing?
I think that it's very clear, and I think the language gives us the authority that we need.
Okay, so now we know what we should be doing. How long would you anticipate it's going to take to implement the statute with regards to 2155?
So with regards to that particular provision, we're thinking already about exactly how we will, the framework we're going to publish for comment and receive public comment on that will allow us to identify systemic risk or risks to safety and soundness among banks below 250. The other aspects of 2155 were already out the door. We published a document on Friday of July 4th week, which talked about how many things that we're doing. We have a big job to implement 2155, and we're going at it very hard.
Thank you very much. And it's nice to know that, or it should be noted anyway, that those banks under 250 are not significantly important financial institutions standpoint of endangering the economy. That's what a SIFI is supposed to be, a bank that would endanger, while they're nice-sized banks, they're not something that's going to endanger the economy, and therefore they fall under different regulatory regimes. So we thank you for that. With regards to another issue I brought up yesterday, former Governor Dan Tarullo said in his farewell address that stress testing programs should be moved into the normal examination cycle. And I agree with that proposition and said, while I don't underestimate the importance of stress tests, those tests should be run by regulators. Banks are doing this right now on a regular basis with regulatory oversight. Would you agree with Governor Tarullo that we need to sort of assimilate those exams, the stress testing things, into the regular examination cycle, or do you want to retain those as a separate type of testing that the banks are going to be putting out information for and modeling?
I believe he was talking about the qualitative aspect of the test.
Right.
Right. So we are looking to return the qualitative part of the test over time to the regular examination cycle, and we're looking for the right way and time to do that.
Well, it seemed to me, just to throw ideas out, that it would seem to me that if we would, if the Fed would have several different models, and then they would go into the bank, take the information from it, throw into those models to see if there is a area within the bank's business model that is of concern, that could be pointed out by the various models and update those models on an annual basis or whatever it would take. But it seems to me like now that the stress testing is a game of gotcha. The models are not disclosed until the very last instance, and then are the models going to actually be useful? So I think I would hope that you would think along those lines, that you could assimilate it into part of the examination process, take the information and put it into several different models to see if there is a weakness somewhere in the bank's business model. Does that make sense?
Yes, although as you know, we're working hard to make the quantitative side of the test and the qualitative side more transparent to the public generally and to the firms, and we think that that's a key innovation. We've got a proposal out on that.
And one of the things, also with regards to international banks, I've had some visits from our friends across the pond recently, and so while I'm a staunch advocate for capital, I'm also concerned about this notion that arbitrarily parking capital around the globe creates a safer financial system. The Fed started this trend with FBO rule, something I pointed out to Chair Yellen during her tenure. Now Europe is following suit with the immediate parent undertaking rule, which will hit the U.S. and ultimately UK banks. It seems as though we're finding ourselves in a global back and forth here with regards to capital. Would you agree with that, or what are your comments?
I think we feel like our intermediate holding company regulation is working. It's settled down now, and it's working. We've been consulted as Europe has looked at something similar to that, and I think the last time I checked, we felt that our concerns were being reasonably well addressed. I'll look back, though, to make sure that's right.
And one of the questions I got yesterday from a group of politicians from Europe was with regards to equivalency. And I'm not a big fan of that from the standpoint of the equivalency of rules and regulations. Somebody wins and somebody loses. And I'm fearful that we're going to lose in that situation. So just a comment. Thank you very much for being here. I'll yield back.
Time of the gentleman has expired. The chair now recognizes the gentleman from Missouri, Mr. Cleaver, ranking member of our Housing and Insurance Subcommittee.
Thank you, Mr. Chairman, and thank you for being here, Mr. Chairman. Last week we were here having a conversation with Secretary Mnuchin, and when I raised issues. They related to the fact that I represent a rural part of the state of the state of Missouri. Excuse me. And I had a town hall meeting in Higginsville, Missouri, 2 weeks ago, and brought in the Canadian Consul General to talk with the farmers in my district. Standing room crowd. Nobody in there supported what was going on. Many of the farmers, or some of the farmers, are questioning either, whether they should allow the beans to just stay in the fields this year, because as you probably know, the price is continuing to fall since the tariffs were implemented. First of all, I'm concerned about whether or not the harm could spread and do damage to the economy. I know you asked a similar question earlier, but it stands to reason that if the soybean crop is damaged, as it apparently is, there has to be some kind of a rippling effect. And I'm wondering, right now we're just talking mainly about, some farm products from my state. I think China buys $60 billion a year in soybeans, just in soybeans, $60 billion, and from us, from the United States. So I mean, if you just deal with the $60 billion, is there a cause to be concerned about the damage that other parts of the economy could experience?
The answer would be yes. I mean, you're just beginning to see the retaliatory tariffs come into place. They're only just beginning, and so we hear a few reports here and there about this company and that company. The agricultural patch is clearly very seriously affected, but it's just beginning. So I think, you want to be careful to walk on this path because it may not be so easy to get off it.
And I have a weird. I have a large rural part of my district, and then I have the largest city in the state, Kansas City, in my district. And so I've talked about my farm problem. When I was mayor of Kansas City, I was successful in bringing Harley-Davidson to Kansas City. They built a new plant, went up to 1,000 employees. We made an investment as a city. Of course, we're now facing the possibility of an empty building. But the steel tariffs are going to also be have a rippling effect. The Smoot-Hawley Act is credited with making the Depression even worse. But I'm just wondering if I mean, you're not going to answer this question, I understand it, so it's almost a statement, I have to say it. I think when decisions like this are made, they probably should be made with the legislative branch of the government, because the issues are too significant for one human being on the planet. I don't care if it's a Democrat or a Republican or, the member of the Oakland Raiders. We're talking about the world economy being impacted, and only one person has something to say. And frankly, Congress hasn't spoken on issues like this since 1930. I mean, we've just been frozen out of the process on an issue that can impact the entire world. Thank you for listening to me. And I'd also just like to yield back, Mr. Chairman. I'd also like to express appreciation that you speak English. When I was first elected to this committee, we didn't, a lot of people from the Fed didn't speak English.
Thank you. Thanks.
Thank you.
The chair takes note that the chairman of the Fed speaks English. Chair now recognizes the gentleman from Michigan, Mr. Huizinga, chairman of our Capital Markets Subcommittee.
Thank you, Mr. Chairman. Chair Powell, good to see you again. And I think my friend from Missouri is very pleased to hear English versus economies or economistism or whatever you want to tag it with. But This clearly is some kind of complicated stuff. I've got a number of issues I want to hit on very briefly, and one of them is just kind of a simple thing, something that we have talked about with the FEC, the Form Acts bill that I had proposed previously. We had a provision that we had put in there that each Federal Reserve Board governor should be able to hire up to 2 senior staff members, and just wondering if you could maybe briefly comment on that, or whether you've looked at that.
I think it's a good idea. Don't need legislation on it. That's kind of now the rule.
All right. Well, good. We're making progress already. As chair of the Monetary Policy and Trade Subcommittee, I had worked on monetary policy and how the effects of that. Now, as chair of the Capital Markets Subcommittee, we still see a lot of that tie-in and sort of the world economy and the health of what's going on. I've got some real concerns about the Volcker rule situation. Last month, the Fed, along with the other 4 federal agencies, something that Mr. Quarles had called the 5-headed Hydra at one point, had put some proposed rule changes in there. And my understanding is that the goal of the new rule is to simplify the regime and make it easier on the regulators as well as the regulated institutions to identify proprietary trading while allowing banks and to continue providing important market-making activities. How do these reforms address the Volcker rule so that compliance can be streamlined, rules clarified, and markets actually made more efficient?
I think for the smaller institutions, we'll be streamlining quite a lot. Let me say this rule is out for comment, and we're very, very open to better ideas how to do this better. But we want to stay faithful to Congress's intent, which is these institutions, particularly the largest ones, should not have big proprietary trading businesses, shouldn't be doing proprietary trading as a business line. So
I look forward to continuing exploring how the Fed and FOMC will be properly tailoring the Volcker rule. However, I have been hearing some complaints for some companies that the proposed rule as introduced has a new concept of using accounting rules to identify prop trading, which were not included in the original Volcker rule. And I've been told that this could actually result in more activities getting caught up in the Volcker regime than there are pulled in today. I'm just, can you please tell me how that result, to simplify the rule, appears to make it actually a little more cumbersome and complex? Again, my understanding is new metrics regime could result in roughly 50% increase in metrics reporting by the banks subject to the rule.
So that's not the intent at all, and I assume we're going to see those comments through the comment process, and believe me, we'll give them careful consideration.
Okay, and we're kind of wide-ranging and far afield here on a number of issues. My next issue, page 39 in your report, you had your chart about the rules. You mentioned this on page 5 of your testimony. You gave an update on monetary rule. This is a quote from your July Monetary Policy Report. It gives an update on monetary policy rules and their role in our policy discussions. I understand you have a series of rules that you reference as you are moving forward, including the Taylor rule adjusted, the Taylor rule as it is. What is the balanced approach rule? I mean, I'm not familiar with that. Balanced approach rule would have called for the most negative interest rates during the downturn, and could you unpack that a little bit?
So each of the rules has, most of them have, they have an estimate of the neutral rate, inflation. They've got how far you are away from your inflation target and how far you are away from your unemployment target or your slack target. What the balanced rule does is it doubles the coefficient on the slack target. So in this case, unemployment. So the weighting is doubled on.
Okay.
That's all it is.
And then real quickly, Chairman Barr had talked about the yield curve flattening, and I'm wondering if there could be circumstances when what might be good for the federal government, lower interest rates long term as we deal with our national debt load payments, frankly, might that not necessarily be beneficial for the overall economy?
So we're not concerned with. We're concerned with carrying out the mandate you've given us, which is maximum employment, stable prices, financial stability. We're not concerned with fiscal.
Do you have discretion as to whether to sell short-term versus long-term?
Sure.
Okay, and if you sell long,
we don't sell any assets. We let them mature.
Okay, well, so okay. Well, I will have to follow up with some written on that because I am curious if you did sell those long terms, could the long-term rate go up? So, thank you, Mr. Chairman.
Time of the gentleman has expired. The chair now recognizes the gentleman from Connecticut, Mr. Himes.
Thank you, Mr. Chairman. And Chairman Powell, welcome. It's a pleasure for me to have this opportunity to chat with you, something I hope we can do on an ongoing basis in future. I want to use my 5 minutes to ask you about two specific risks and for your elaboration thereon. The first one is related to financial stability and stability in the overall financial system. I watched carefully the conversation you had with Senators Warren and Brown about capital. I'm actually interested in hearing you for a couple of minutes, because I do have two questions. Elaborate on risks that we might not see coming that aren't conventional capital risks. So my concern, of course, is that we tend to get hit by the bullets that we don't see. And while we're focused on Volcker rule or capital, what happens, what comes upon us out of nowhere? These things tend to come with a speed and severity that we don't predict. So what keeps you up at night that is not sort of conventional capital ratio type issues? Is it student loans? Is it proprietary trading? Is it ETFs? Elaborate for me, if you would, on things that concern you with respect to stability in the banking system in particular.
So the clear answer to me from that would be cyber risk. We've spent 10 years building up capital, helping the banks be much more conscious of their risks, building up liquidity, stress testing, all those things. And we have a really good playbook there. I think we carefully monitor all of the things that you mentioned, although some of them are worth talking about as well right now. But the thing that is really hard is the idea of a successful cyber attack. And we work hard on having a plan for that. The administration plays a leading role in that. But that would be the big one. I think if you turn to traditional financial stability, we think that risks are sort of at the normal/moderate level. You see some high asset prices. You don't see high leverage among households or among banks. You do see a little bit of high leverage in non-financial corporates, and that's something we're watching very carefully. But again, nothing really is flashing red in our observation of it in the financial markets.
Let me ask you to elaborate. You said there are some worth talking about, and then you highlighted asset prices. Which category of assets in particular were you?
Just generally, you've had 10 years, or almost 10 years of low interest rates, and we're in the process of normalizing policy. Bond prices are high, equity prices are, broadly speaking, commercial real estate prices are in the upper range. I think generally elevated. I wouldn't use the bubble word here, but I would say that many financial asset prices are elevated above their normal ranges, and we'll have to see.
With respect to cybersecurity, which is where you started, what would you recommend to this body that we do as you do your reviews and whatnot within the banking industry? What should Congress do to assist in the process of addressing cybersecurity risk?
Well, I would say as much as possible, and then double it. So we do a great deal, and it's about making sure the banks have basic plans in mind. A lot of it is just basic cyber hygiene and making sure that your systems you're implementing the latest things that come out and that sort of thing. And I think planning for failure too is very important. That's what we do. We do everything we can to prevent a failure, but then you've got to ask yourself, okay, what would we do if there were a successful cyber attack? You got to have a plan for that too. So those are the things we're working on.
Okay. Let me ask you another category of risk that is maybe a little bit more sensitive, but like so many people, I scrutinize the words in this report. My words, not yours. Very bullish on the economy, careful on inflation. You note that inflation has moved up. Our challenge will be to keep it there. I'm reflecting on where we've been in the last 10 years in that regard. We saw a pretty substantial fiscal stimulus in 2009. My friends on the other side of the aisle completely rejected Keynesian economics at the time and said that wasn't going to work. They then had an epiphany and embraced Keynesian economics around a $2 trillion deficit-financed fiscal tax cut at a time in which the economy was growing robustly. It's been a long time since I studied economics, but stimulus in the face of a robust economy concerns me from the angle of inflation. You say that the 2% objective is symmetric in the sense of your concern. How would you divide the probability that we see upward trending inflation versus downward trending inflation going forward from this point?
I would say it's roughly balanced. I think maybe slightly more worried about lower inflation still, but I think for a long time, inflation was below target and we were pushing up. We've now just about reached a symmetric 2% objective, so it's very close. And I think from this point forward, the risks are roughly balanced.
Thank you. Thank you, Mr. Chairman.
Time of the gentleman has expired. The chair now recognizes the gentleman from North Carolina, Mr. McHenry, Vice Chair of the committee.
Well, Chair Powell, thank you for being here. Thank you for being here. I want to shift to cryptocurrency, so, which is a bit of your monetary policy hat, but also a bit of your regulatory hat. And I want to get your thinking along the lines of cryptocurrency. So, the Bank of International Settlements just released a report saying that cryptocurrencies were, quote, a poor substitute for the solid institutional backing of money. You've stated publicly that the cryptocurrencies are currently not big enough yet to matter, or something along those lines. I would submit the report by the Bank of International Settlements misses the mark of the potential of blockchain, the potential of crypto more broadly. But there's a great deal of interest in your views and central banks' views more broadly on cryptocurrency. So can you just outline to me your thinking on cryptocurrency?
Sure. So first, I would say, I think the question I was asked that you're referring to was, do cryptocurrencies currently present a serious financial stability threat? And my answer was, they're not big enough to do that yet.
Sure.
That's really what I was saying, not that they're not a longer-term thing. So they are very challenging because, cryptocurrencies are great if you're trying to hide money or if you're trying to launder money or if you're, so that we have to be very conscious of that. I think there are also significant investor risks. Investors, relatively unsophisticated investors, see the asset going up in price and they think, this is great, I'll buy this. In fact, there is no promise behind that. It's not really a currency. It doesn't really have any intrinsic value. So I think there are investor consumer protection issues as well. Another thing I'll say is that we're not looking at this at the Fed as something that we should be doing, that the Fed would do a digital currency. That's not something we're looking at. So mainly, I have concerns. I mean, if you think about what currencies do, they're supposed to be a means of payment and a store of value, basically. And cryptocurrencies they're not really used very much in payment. Typically, people sell their cryptocurrencies and then pay in dollars. And in terms of a store of value, look at the volatility in it. It's just not there.
Well, has there been discussion with other G7 central banks along the lines of cryptocurrency?
It comes up a lot, yeah. I mean, I'm only just starting to go to G7 meetings, but it comes up quite a bit in international forums of various kinds. There's a broad concern that the public needs to be well informed about this, I think, and that again, the money laundering and terrorist financing and all of that is a big risk.
It's a big risk, but is there any conclusion that you're hearing, or is it just a broad concern?
Well, I think the BIS report and others have called out these risks and called on the appropriate regulatory bodies to address them. We don't have jurisdiction over cryptocurrency. We have jurisdiction over banks, and so we know in their activities with cryptocurrency companies and cryptocurrency, we can address that. Others can address the SEC can address the investor protection aspects of it.
But you don't see this as impairing your ability to act on monetary policy,
not
just
today.
given the current shape and scope of the size of the market?
Really not at all today.
Okay. So, we currently have some level of framework around regulation of cryptocurrency. You got a money service license at the state level. In our 50 states, they all have some requirement. So there's a great look into that conversion, the movement of cash into cryptocurrency or out of cryptocurrency back into cash. We have some element of regulation at the CFTC and the SEC. So there is some broad framework of it, but not a concerted effort by the federal government to understand what's happening in cryptocurrency. Do you have any staff resources devoted to figuring out cryptocurrency or following cryptocurrency?
Yes, so we've looked at it carefully. I spoke about it. Other governors have spoken about it. Reserve Bank presidents. There's plenty of work going on. But again, we don't have this regulatory authority to deal with it. So I think that's the key thing is to be looking at the places where there is that regulatory authority.
Okay.
So,
thank you, Chairman.
Jim yields back. Chair now recognizes the gentleman from California, Mr. Vargas.
First of all, I'd like to thank you for one thing that's obvious, and that is that you haven't gotten yourself in trouble. And thank you, Mr. Chairman. You haven't gotten yourself in trouble. You've been a great public servant, and I really appreciate that. Unfortunately, you shouldn't have to say that these days, but you really do, what we've seen recently. I do want to ask a little more about cryptocurrency, however. You talked about terrorism, and you also talked about hiding money. I had a bill here with a colleague of mine on the other side exactly on that point, and I'd like you to go a little deeper on that. You said it's not an issue yet because it's not large enough, but it does seem to be growing. And you said you also don't have jurisdiction, over the banks. Should you have jurisdiction here, cryptocurrency?
that's a deep question. We're not seeking it.
But should you?
I'm not going to say yes today. I don't. We're not looking to. You know, it's right in the middle of the SEC's turf, the investor protection aspects of it. I think Treasury and FinCEN and other people have. I think it should be well regulated. I don't really see us as probably the right group to do that.
But it seems to me right now that no one seems to have quite a hold on it either. It seems to be this amorphous glob that's moving around. You talk to the SEC and they, at the same time, kind of kick the ball around also. I mean, shouldn't there be a more concerted effort to try to figure out who's in charge here of cryptocurrency? Because I think that there is lots of opportunities here for not only terrorism, but also for drug trafficking, sexual exploitation, human trafficking. You said terrorism, but all sorts of bad actors, I think, can use this. And I don't think that we have a good hold on it yet.
I think it's a good idea to focus on getting the regulation at the federal level of this right. Again, we're not seeking that at the Fed, but and I know Treasury has done some thinking on this. This would be an area where they'd have the lead to sort of identify the right regulatory structure. They may have already published something on this. I'm not sure.
In fact, part of the bill asks them to speed that up and to report back to us. I do want to ask you also about the issue of wage increases. You said that there's been some movement upwards, 2%, 3%. I think you said 3%, and so it's beating inflation. Yes. But the question was then specifically on people of color, African Americans and Latinos. You said you had some breakout numbers for those?
Not handy, I don't. I can get those for you.
Okay, I'd be interested in that because I see the same situation in California where you have people that have been underemployed, working very, very hard, 2 and 3 jobs, and they continue to say that they haven't seen that wage increase yet. We have seen for sure, and I think you're correct about the unemployment go down, but we haven't seen yet, certainly not in my district, in any measurable way, the increases in wages.
So wages in general have been somewhat slow in moving up. And as the labor market has tightened, and we understand that really matters to people's lives a lot. Yeah. And we do see them moving up in the aggregate, but I'll also be happy to supply.
You said there was an issue of productivity because maybe this time the reason the rates haven't increased as much is because of productivity. Could you talk about that for a second?
Sure. So over a long period of time, wages really can't forever go up faster than productivity. Productivity is slow, but there's a reason for that, and that is after the financial crisis, there are many reasons for it. After the financial crisis, though, companies didn't invest much because there was no need to, there wasn't demand, the economy was weak, and so weak investment drives, it casts a shadow over productivity growth for a number of years. So we're still, investment has now popped up. Investment was strong in 2017, that continues in 2018. That's really important, and we're glad to see it. But it may take some time to show up in higher productivity. It's not because people aren't working harder. It's because you need those information technology and other tools to be more productive.
And again, with the last moments that I have here, I just want to thank you again, the way you've comported yourself. the way you've been open to talking to people, the confidence that we have in you. I think the American people really need at the moment someone like yourself that we can look up to and say, you're not involved in any kind of scandal. You're not involved in any other thing out there that would lose confidence. It's just the opposite, and I want to appreciate that, and thank you for that.
Thank you, sir. I'll try to live up to that.
I hope you do.
Gentleman yields back. Chair now recognizes the gentleman from Wisconsin, Mr. Duffy, Chairman of our Housing and Insurance Subcommittee.
Thank you, Mr. Chairman, and thank you, Mr. Powell. I'm up here on the back row. You probably can't find me. Some of my colleagues on the other side of the aisle have discussed harmful economic policies, some in their opening statement specifically. So if you look at the harmful economic policies that have taken hold over the last year and a half. So President Trump has worked hard to streamline and reduce regulation. We had a historic tax cut. We've tried to rebuild our military. We've pushed for American energy independence. If you take together all of, I would quote, those harmful economic policies, what has that actually done for the African-American unemployment rate in America?
As I mentioned, I think...
Has it gone up?
It's gone down significantly.
Say that one more time. What's happened to African-American unemployment?
It's come down quite a bit.
It's come down quite a bit. How about the Hispanic unemployment rate? Has that gone up under these harmful economic policies?
It has come down quite a bit.
It's come down quite a bit. So is it fair to say these policies actually aren't harmful? They're actually growing the economy. They're putting people back to work. Is that a fair assessment, Mr. Powell?
It's fair to say that the unemployment rates are very low, and that a lot of things go into that.
So you wouldn't say today that it has anything to do with regulation or tax?
I'm reluctant to get into the credit assignment game. It's really not up to us. I can report on the economy, but I do think that.
But I know, but you report on the economy and you look at all the different factors that come into play in the economy. And so, have these factors had anything to do with the growth that you have seen in this economy?
So I attribute declining unemployment to, positive surveys among businesses. Really, they feel good about the business climate.
Why do they feel better about their businesses, Chairman? Because they get to keep a little more of their money? Is that possible?
Certainly.
Maybe? How about if instead of having to navigate government rules and regulations, they actually get to focus on running their business? Could that attribute to the positive view they have on the economy and their businesses?
I think you've seen very positive business confidence surveys.
Okay. So I'll take it that you're not going to answer my question. I understand the position in which you sit. I want to talk to you about trade. I'm a free trader like you are. I think free trade is great for our economy. But I also think that if you don't have fair trade, if you have deals with places like China where you have American companies that invest millions or billions of dollars in their technology and you do business with China and they steal it from you, or they subsidize their companies that come and do business in America where we have, for the most part, free trade ourselves, where we actually can't, they have barriers to American-produced goods. How long does that relationship last where our economy is open, theirs is closed? Does that set us up for a long-term successful economy as it relates to China?
So I strongly agree with you that trade needs to be fair as well as free.
Is it fair now?
Well, I think if you look at the rules-based post-war system, it's consistently resulted in lower and lower trade barriers.
That's not, no. Our relationship with China, is it a fair trade? Do you have a fair trade relationship with China?
I think it's very clear that some countries, and China in particular, have less open trading systems than we would like, and it's
not fair.
Appropriate for us to address that.
And so, do you think it's easier to deal with China 15 years from now, when their economy is that much larger and stronger, or maybe their military is larger and stronger than it is today?
That's really a judgment for the people who have responsibility for trade policy.
I would agree with that. I'm going to quickly turn to the President's America First policy. Do you agree with that?
Maybe you could be more specific.
Well, do you think we should put American interests first? Do we think we should look out for the global interests or American interests?
I mean, we work under a statute that has us focused on maximum employment and stable prices here in America.
Maximum employment for Americans, not for the globe, right?
In America.
So we're looking out for
Of
Americans.
course, we live in a global economy where the global economy affects that.
No, that's true, but we can look at the global economy, but always how it affects our own
Entirely
people.
domestic. Our goals are entirely
Do you
domestic.
believe the U.S. insurance companies are well capitalized and solvent today?
Yes.
Do you believe that our system of regulating American insurers has worked well over the last 150 years?
I can speak to the last decade or so, and I'd say yes.
Pretty good, huh? So would you agree that we should not enter any international agreement or standard setting that would undermine our U.S. Insurance regulatory system, state-based model?
Yes, yeah, I would.
Great. My time is up. I yield back.
Time of the gentleman has expired. The chair now recognizes the gentleman from California, Mr. Sherman.
I commend the gentleman from Wisconsin and the chair of the Fed for their comments about insurance, and I'll probably disagree with many other things. Thank you once again for returning, where you will be independent and accountable, tall and short. The Fed plays an interesting role. First is to cryptocurrencies. You and we should have the courage to ban them. As an investment, they're an investment with no investor protection. And they take the animal spirits, the willingness to invest, divert them from the real economy, and instead engage in what is basically gambling. Many jurisdictions support gambling only if there is local taxation, but cryptocurrencies don't pay gambling taxes. As a medium of exchange, cryptocurrencies offer no advantages over regular currencies unless you're a terrorist, a narcotics dealer, or a tax evader. There is no positive role for us for cryptocurrencies. A lot of discussion in here about who deserves credit for the good economy. Let me point out, since Dodd-Frank, 17 million jobs have been created, 15 million of them under Obama, 2 million under Trump. That's 15 million, 2 million. That's the right ratio. Now, the Trump administration claims credit for the last 3 months of the Obama presidency, but Obama was actually president until January 2017, but his policies remained in force all through 2017. Dodd-Frank, Janet Yellen's balance sheet, and Obama tax policies were in force until the beginning of this year. And in fact, the Fed policies and the securities regulation remain pretty much unchanged since the Obama administration. The chairman of this committee urges you to abandon all of the unconventional tools while taking credit for the good economy that is in part a result of your unconventional tools. I would say keep your balance sheet as big as it was when we achieved the economic growth that is so good that Democrats and Republicans are fighting over who gets credit. And certainly do not cut your balance sheet until Chairman Hensarling tells you how he's going to increase taxes to replace the $80 billion of profit you gave us last year because you had a big balance sheet. The chair talks about the inflation rate, the chair of this committee. You ought to have a goal of 2.5%, not 2%. The law that we passed in 1978 draws a 3% objective or maximum for inflation and for unemployment. So unemployment is still too high and inflation is too low, and if we have a looser economic policy, maybe we'll get somewhat higher inflation and the labor shortage necessary to increase wages. He puts forward the idea that somebody would save for their daughter's college education by putting money aside, but in a mattress where its value would decline by 30% by the time his young girl got to college. I'd say if you're smart enough to save for college education once your daughter is born, you're probably smart enough to invest the money in something that grows faster than inflation. As to trade, my party suffers from Trump derangement syndrome, which is whatever Trump does, we have to be the opposite. The fact is, China launched this trade war against us in the year 2000, right after 2/3 of Democrats voted against giving China most favored nation status. We were right then. We shouldn't change now. If there are those who say that trade deficits don't have a harm, they lead to hollowed out manufacturing, which leads to manufacturing towns where you have opioids, alcoholism, and votes for Donald Trump. 3 terrible scourges that hit the Midwest. As to your testimony, Mr. Chairman, you say that Wages are growing a little faster than they did a few years ago. That's nominal wages. Real wages, if anything, have stagnated over the last year, depending upon your measure of inflation. One more reason for a looser monetary policy, faster economic growth. And believe it or not, I have a question. That is, LIBOR was tainted by a scandal. You've got the Alternative Reference Rates Committee. Most of the LIBOR referenced debt is derivatives, but what really matters to people is mortgages. And what are you going to do to make sure that the new benchmark doesn't increase mortgage bargaining costs or disrupt the mortgage market?
So
that's the one question.
That's great. That's a great question. So you're right. Many mortgages reference LIBOR. LIBOR is a rate that's under a lot of pressure. It may not be there in 3 or 4 years. So there's a big move to find a good backup. We've identified a backup, and it's not designed to represent an increase at all in people's mortgage costs. Rather, it's designed to represent just a more sustainable rate that'll always be there and less volatile and more predictable, more reliable.
And it'll be as good for mortgages as it is for derivatives.
Yes.
Good.
The gentleman's time has expired. The chair now recognizes the gentlelady from Missouri, the chair of the Oversight and Investigation Subcommittee, Ms. Wagner.
Thank you. I thank the chair and welcome Chairman Powell. In comments that you made shortly after being sworn in as chairman of the Federal Reserve, you noted that you were committed to, and I quote, explaining what we're doing and why we are doing it, and will continue to pursue ways to improve transparency both in monetary policy and in regulation. Sir, how much value do you place on being as open and transparent as possible so that not only Congress but the American people understand the decisions the Fed is making, why they're making those decisions? I'm just interested in what that kind of transparency and openness looks like.
So I think it's our obligation to explain ourselves. What we do is very important, sometimes not well understood, and it's really on us to explain what we're doing with financial regulation and monetary policy. We have this precious grant of independence. We have to earn it by being accountable, and the way we do that is through lots and lots of transparency. I mean, I see myself as following in the footsteps of 3 prior chairmen who worked on this: Greenspan, Bernanke, and Yellen.
When you say transparency, what are we talking about in a specific
In my case,
fashion?
you know, so we doubled the number of press conferences. I'll have
Okay.
a press conference after every FOMC meeting. That's in monetary policy. That's a way for me to get out and talk about what the committee did at each meeting and communicate to the public in a comprehensible way. I've also focused very much on communicating in terms that people can understand generally, not just economists. There's a very small professional audience that understands what we do very, very well, and you know, economists in Wall Street and that kind of thing. And I think the rest of the country needs to be let in on this too, and I'm trying very hard to do that.
I absolutely agree, especially in this era where we have a savings crisis and people need to understand the movements that you make as Fed chair, how it relates to monetary policy and how it affects them and how they invest for their future. So I absolutely applaud your efforts in terms of press conferences, but also trying to shape the vernacular so that everyday low and middle income investors and savers in this country can understand what your policy actually means to them personally. In 2012, the Fed dealt with a leak of confidential information relating to the deliberation of the Federal Open Markets Committee, FOMC. As you know, access to that information is valuable to markets and investors because the Fed does not make clear what it is likely to do in the future. The committee believes that a monetary policy rule would provide the public transparency into future monetary policy decisions and eliminate the value of leaks. Again, you've talked a lot about being transparent, and we've discussed it here previously, but you're the new boss, and what's going to change on the issue of securing some of that confidential information and transparency to prevent this going forward? And then also, when will the board improve its internal governance so episodes like these don't repeat themselves, sir?
We take the confidentiality of our deliberations very, very seriously. As you, I'm sure know and would imagine. And you know, we remind every person who has access to FOMC information, including all the participants, but also all the staff, every year have to review those rules, have to signify that they understand, have read them, and are bound by them. So we do all of the things we can humanly think of to make sure that people understand their obligations to confidentiality, and I think
if I could interrupt, sir, as chairman of the Oversight and Investigation Committee, we have looked into this specific leak. We've had difficulty receiving, I think, specific information about your internal governance and exactly, you know, how it is that we make sure these episodes don't repeat themselves. So, you know, I'd like your brief comments on that, and also want to work with you to make sure that we're receiving the information in our role of oversight and investigation into these kinds of matters.
I'll be happy to take that offline and talk to you about it. I don't know what you're referring to about information you can't get. Obviously, there's a lot of confidential information that we don't release, that we try to protect. But in terms of our procedures and the kinds of things that we do, I would think that that's the kind of thing we...
Specific to improvements of internal governance, I believe so. Okay. I thank you. I look forward to following up with you. And Mr. Chair, I yield back the remainder of my time.
Gentlelady's time has expired. The chair now recognizes the gentleman from Georgia, Mr. Scott.
Thank you, Mr. Chairman. Chairman Powell, excuse me. Welcome back again, and I want to thank you for spending some private time with me. We had a wonderful discussion and covered a lot of territory when you were here last. But I watched your testimony over in the Senate on yesterday, and I want to clarify something with you. You talked about the regional banks, those banks that are at the between 100 billion and 200 billion in range. And you talked about Senate Bill 2155, which I supported very strongly, and we got good support on in terms of the banking regulations. But in Senate Bill 2155, we gave you, the Fed, substantial authority through rulemaking to tailor regulations for these mid-sized banks, for these important regional banks. And I watched the testimony, and you reassured the senators that the Fed wasn't going to just flip the switch off on a bunch of the enhanced prudential standards, but instead would diligently work through a thoughtful and careful rulemaking. And I was very pleased to hear that. But I want to ask get some clarifying information from you. Because Georgia, as you may know, is the home of a couple of these very important regional banks, Regions Banks and SunTrust Banks. And the question is, do you envision the end product of this thoughtful and diligent rulemaking process to be a set of enhanced prudential regulations to these SIFI banks that is drastically different than those of the G-SIBs or the global banks?
I anticipate that we will begin by identifying and then putting out for comment a framework that we'll use to assess financial stability and safety and soundness risks of those institutions from 250 down to $100 billion. And we'll take comment on that, and then we'll go ahead and move forward with a framework. And I anticipate that many of the factors that are used to identify the SIFIs will be used in this context as well. We're still working on exactly how to think about it. We have great flexibility under the law, which we appreciate, and we'll be coming forward with something on this pretty quickly, I think.
Do you see any problem areas that these mid-sized banks or regional banks might have to be concerned about? Or do you see a sort of a clear field here?
Well, I guess I would just say we're going to go ahead and do what the law asks us to do. I don't see why anyone should be concerned about that.
Good.
So.
Wonderful. That's good to hear. Those banks, all our banks are very important, but we have so many different sizes, and we got to make sure there's a level playing field for all of them. Now, let me ask you this question. You know, one of your fellow cabinet members was here, the Treasury Secretary, and we got into discussion on the trade situation. So I want to ask you a question that I asked him, and I'm hoping I will get a different answer. And that is this: are we or are we not in a trade war?
Let me say, of course, as an independent regulatory head, I'm not a member of the cabinet, but and also I'm not at an independent agency that has any authority over trade.
But the reason this is so important, you may not be a member of the cabinet, but let's face it, Chairman Powell, when you sneeze, Wall Street gets pneumonia.
Better than the other way around. So on this, you know, we do have responsibility for the economy, and to the extent we see.
But my time is coming out. I need an answer. Are we or are we not in a trade war?
It's just not for me to say. Sorry.
Well, Mr. Powell, you are our anchor. You are, as the head of the Federal Reserve, the fulcrum of our economic system. And on top of that, I've talked with you, and you are a very learned, intelligent person. And you have a very important opinion that the people of this nation would want to hear from you. Are we or are we not in a trade war?
The gentleman's time has expired. The chair now will recognize the gentleman from Oklahoma, Mr. Lucas.
Thank you, Mr. Chairman. And Chairman Powell, you are my fourth chairman of the Federal Reserve that I've had the opportunity to interact with as a member of this committee. And I've over time come to appreciate that the best use of my time perhaps is to focus on more specific issues, since my friends are very broad sometimes in their inquiries of you. So I'd like to ask you about the recent proposal the Fed released with other agencies regarding the Volcker Rule. And while a great deal of attention has been paid to the proprietary trading restrictions, I'd like to focus on the manner in which banks have been restricted from making long-term investments in small businesses, startups, emerging growth sectors as a result of the covered funds provisions. I can understand that the agencies want to ensure that banks cannot evade the trading restrictions of the Volcker Rule through certain private funds, but I am concerned that the agency's interpretation of the restrictions on investing in funds that facilitate capital formation has resulted in prohibitions on an activity that we want banks to engage in, such as making long-term investments in American companies to help them grow. These restrictions cut off as a source of capital where they are both needed and important to economic growth. And I will note that the venture capital groups also share my reservations, and Comptroller Auditing testified last month that bank lending provided key funding to small businesses by investing in these funds. Do you have any plans to modify the scope of the restrictions on banks' long-term investments in covered funds so that the banks are able to serve as an important source of capital to these funds?
As you know, we put out that proposal, and we're very eager to hear comments on that. I think we're bound by what the statute says, but within that, we don't see this as an activity that typically threatens the safety and soundness. So, you know, we'd be willing to do whatever we can within the statutory language and intent to accommodate that activity.
I'm going to define that as a very positive answer. And in the respect for my colleagues, yield back the balance of my time, Mr. Chairman, while I'm ahead.
Gentleman yields back. The chair now recognizes the gentleman from Texas, Mr. Green.
Thank you, Mr. Chairman. I thank the ranking member as well and welcome the chair back to the committee. I want to thank you for this effort that you're making to talk to members of Congress. I think it's important for you to hear from us, and I appreciate greatly your outreach. Also appreciative that you've made some reference to African American unemployment in your statement for the record. I think that's important as well. And like many, I salute the notion that African American unemployment is low, comparatively speaking, but I still am concerned about the historic position that it continually occupies, and that of being twice that of white unemployment, generally speaking, sometimes a little bit less, sometimes a little bit more. And to this end, you and I will continue our interaction about this, see if there are some things that we may be able to do collectively to have an impact. I want to move quickly to something related to the United State of Texas and tariffs. Texas is the 10th largest economy in the world. And based on GDP, it is, of course, our nation's top exporter. In Texas, we export $42 billion in goods to China, second only to Mexico. Half of the U.S. cotton exported to China comes from Texas. While you have not captioned it, you've not styled it as a trade war, I assume that you would say there is a dispute. And this trade dispute is having an impact on people in Texas. But I'd like for you to give your thoughts on how it will impact middle-class Americans, if you would.
Sure. So I think as it relates to China, it's appropriate to address the problems with China's trading regime as well. That's a very appropriate thing for the U.S. to do, and we've been doing it for a long time, and I think it's something to carry on. I think, and again, we're not in charge of trade, but I think it's hard to know exactly where this process goes. If it goes to a place where we lower trade barriers elsewhere and U.S. trade barriers go down, then it might be worth paying a little bit of a short-term price to get to that better place. Lower trade barriers, lower tariffs, help our economy over time. They make for a better, more productive economy, higher incomes. They don't help every single group, and we need to do a better job of addressing the groups that are not helped by trade. I think if you go more broadly in a more protectionist direction over time for a sustained period, that is bad for our economy. That will mean lower incomes and lower productivity, and I just hope it doesn't go in that direction. But I think it's hard to say where it goes from here.
Well, we do have Canada and our European allies engaged in the dispute currently. So it's a little bit bigger than China. To what extent it will grow is, I suppose, to be seen. But given that it seems to be consuming other nations as well, how, again, will this impact middle-class people, assuming that we continue along the path that we're going?
I think an open trading system worldwide with low barriers is good generally. It creates rising incomes for middle-class people and all different kinds of people generally. Not every group is helped, though, and we know that for factory workers who lost their job over the years. And I think we need to do a better job of addressing those issues.
So is it fair to say that persons who have been traditionally among those who are unemployed at a higher rate, that they'll be impacted adversely to a greater extent?
I think that's probably right. I think the groups who are it's groups who are more at the margins of the labor force, at the lower end of the labor force in terms of compensation, things like that, who get hit the hardest in a downturn. So unemployment goes up the most for those people, and I think they tend to be the ones who are hardest hit by downturns generally.
And for the record, I would simply add that it appears that African Americans would probably be a part of that group, and I thank you for nodding. I yield back the balance of my time.
The gentleman's time has expired. The chair now recognizes the gentleman from Illinois, Mr. Holtgren. I'm sorry, strike that. Mr. Stivers. My apologies, Mr. Stivers from
That's
Ohio.
all good. Thank you, Mr. Chairman. I looked around and made sure I was here for a second. Thank you, Mr. Chairman. Thank you for being here, Mr. Chair. We appreciate your ability to be very accessible to all of us. I know you're in my office. You've been in a lot of our offices. Appreciate that. This hearing today is about the state of the economy and monetary policy. And if you could just give me some true or falses here, we'll give a quick summary to people. Is it true or false economic growth is 3.1% the best in over 20 years?
I don't know where you got 3.1%, but it was 2% in the first quarter. It's going to be way higher than that.
This quarter, that's projected to be 3.1%.
It's going to be
or around that.
Higher than that.
Okay, higher than that.
Quarter will be
all right.
projected to be higher than that.
So, good economic growth. True?
Yes. True.
Low unemployment, below 4%.
It's at 4% today, projected to go lower.
Okay, around 4%. Wage growth is increasing.
Has increased.
Has increased. And we have stable prices.
We're close to our stable price.
Close to our stable prices. So as you think about the full employment mandate that you have, the Fed has historically used the unemployment rate. And over the last 10 years, what we've seen, although it's picked up a little bit lately, is a decline in the labor participation rate. Don't you think that would be a better proxy for you to use when you compare the United States to the UK or Japan? Their labor participation rate is 5 to 7 points higher than ours among working age people.
So we say in our longer run statement of principles and monetary policy strategy that we actually look at a broad range of indicators to define maximum employment. And it's many, many measures of unemployment. It also includes labor force participation. I would strongly agree with you that that's a very important area of focus for us, and I believe for you as well. It's an area where the United States has fallen behind other advanced economies, and it's an area where we need to do better.
I think we need to transition there. There are a lot of people left behind, and whether they're looking for work or not, we need to figure out how to get them moving toward the American dream, and I appreciate you being willing to look at that. Quickly on the Volcker Rule, I just want to speak for middle America. We have a lot of banks in my district, medium-sized banks, little banks. They are precluded from investing in our economy. They can loan to our economy, but they can't invest in our economy. And the preponderance of the wealth that's invested in private equity and other things is on the coasts. If we were to, and I know it would require a statutory change, if we were to allow some of that investment to happen, but separately capitalize those funds at the banks so they can't just come to the Fed funds window, that's the concern, I get it, and why the Volcker Rule is there, it would really help middle America. I'm not asking you to comment on it, but I'd love to work with you on that issue.
Great, we'll do that.
Quickly, a follow-up from Mr. Himes on cyber policy. With regard to the thing that keeps you up at night the most, I think everybody you regulate inside the financial system has incentives that are aligned with behavior that work. Because the customer is limited to a $50 loss, the financial institutions have skin in the game. The problem is many other people in the cyber system, retailers and others, offload their financial risk while they have reputational risk to others. And it's become a jurisdictional fight between our committee and Energy and Commerce. I believe we need to change that, and I think the way to do it is to use cyber insurance the way we used workers' compensation insurance in the 1900s to improve worker safety. If we gave safe harbors for certain coverages and made sure the payouts aligned the incentives, I think you'd be able to price a system, but you'd have a dynamic system instead of naming standards and having them be an out of date the next day. So we look forward to working with you on that. I don't expect you to comment on that either, since I'm just throwing at you right now, but I think it's a different way that maybe can break through our jurisdictional problem inside Congress. But I agree with you, it's one of the biggest threats that we have right now. And quickly, one last thing, and this is a question that I do want you to address, because there have been some comments on the committee about stock buybacks and how they don't do anything, but I think it's important that we note that when a company decides to buy back stock, that money doesn't just disappear into the wallets of wealthy people. It goes to work inside the corporation. It's their way of saying this is a better way to put our money at work. But when you look at stock ownership, many people in the middle class have 401ks, and that money gets a better return for them as well as every other stockholder. So I guess the point is, you know, and you've answered it a couple times, but just to be more clear, do you believe that stock buybacks can help the economy and the middle class, including 401k stockholders?
Yeah, I see stock buybacks as a way for companies to allocate funds that they don't need in their own business through the capital markets to those who do need them.
The gentleman's time has expired.
Thank you. I yield back.
Thank you. And just as an announcement, the chairman has requested a brief break at noon, so we will recognize the gentleman from Minnesota and then take a recess for a few minutes. And now we recognize the gentleman from Minnesota, Mr. Ellison.
Thank you. Good morning, Mr. Chairman. How you doing?
Great, thanks. How are you?
So there's been a little bit of discussion about whether or not real wages have gone up or gone down, but I'm just looking at what was reported by the Bureau of Labor Statistics yesterday. They said that median weekly earnings of the nation's 116 million full-time wage salaried workers rose 2% on the year, but inflation was up 2.7% over the same time period. That says to me that the median full-time wages have actually been falling in real terms for the past 3 quarters. Would you agree with my analysis?
Yes, as
okay.
far as it goes.
So thank you. And I appreciate that because that allows me to ask what I really want to know, which is like why in such low unemployment do we have wages either stagnant or even declining a little bit over the last 3 quarters? And I'll just give you a minute or two to try to give me some understanding, all of us. And it's not a setup question. It's a real question because you would expect with this level of low unemployment, we'd see wages go up, but they're not. So what is some of your observations as to why that's happening?
So if you look at, we look at a range of wages, of course. There are 4 or 5 main ones, but there are many, many others, and they have differences. None of them is exactly right. And if you look at them, they've overall moved up from around 2% to pretty close to 3% now. That's good. We like to see
Not nominally.
This is nominal. Yeah, this is nominal. It's reported in nominal, not real. So that's a good thing, though. We like to see that moving up. I've said before, and I still think I would, you know, you would have expected when unemployment moves from 10% to 4%, you might have expected a little bit more in the way of increases. On the other hand, inflation has been low. Employers are looking at this through the lens of how much are prices going up, and the answer has been inflation's been low, and also how much more output am I getting? How much, you know, in other words, people should earn inflation plus productivity. Both of those have been low through no fault of any worker.
Now, Mr. Chairman, I hate this process because it makes me interrupt you, and I appreciate what you're sharing, so I didn't want to do that. But I think it has something to do with anti-competitive practices that we see across various sectors. For example, many of us have a piece of legislation to ban something called no poaching agreements. Do you know what a no poaching agreement is?
I do, yes.
Could you describe in about 30 seconds for the folks listening what a no poaching agreement is?
So, for example, you work at a fast food outlet. As a condition of getting that job, you have to promise not to take a job at another fast food outlet. It's probably unenforceable, but a worker working in a fast food outlet doesn't have the means to go to court and might not know to go to court. So it's a way of restraining competition, and there's really nothing good to be said about it.
Right, and to me, you know, I think that Congress needs to be aggressive about this, because if we are truly believing in free market economics, the free market is being restrained by these anti-competitive practices. This ought to be a bipartisan thing where we are together saying that if you cannot, Mr. Employer, Ms. Employer, have an agreement between yourselves that you will not hire each other's employees if they go to you looking for a better wage or have a non-compete clause.
I think just shining a light on it helps, by the way. You may have seen some of the big fast food companies announce they won't do that anymore.
Well, because some Democratic attorneys general went after them and they said, okay, we won't do it because they know they're going to be held accountable. But deeper than that, I think, is the fact that we have highly concentrated markets these days. Can you talk about market concentration in this particular economy? It seems like every industry you look at has highly concentrated markets. Look, for example, Amazon, how they're dominating, online retail. Or if you look at search engines, look what Amazon's doing. Or it could even be beer or pizza or chicken or whatever it is. It seems like the other side of a monopoly is a monopsony with a limited number of buyers of labor, which makes it easier for them to simply hold wages down. I wonder what you think about that.
It's true that we do see measures of concentration going up. I think that the sort of tech companies that come out and invent a new business, they're a special case. We're not, and it's hard to know how to think about that in terms of the traditional antitrust and other ways. It's not something I feel like there are really clear answers on yet.
Would you consider having the research department at the Fed talk about concentrated markets and the impact on wages and the fact that they're growing very slow in an unexpected way?
We'll look into that.
Thank you.
Gentleman's time has expired, and pursuant to the announcement just made, the committee stands in recess subject to the call of the chair. The chair anticipates that we will reconvene in 10 minutes. We will come to order. The chair now recognizes the gentleman from California, the chairman of the Foreign Affairs Committee, Mr. Royce, for 5 minutes.
Thank you, Mr. Chairman. And let me ask this, Chairman Powell. Housing finance reform remains the great undone work of the financial crisis, and you have previously called for reform, stating that we need to move to a system that attracts ample amounts of private capital to stand between housing sector credit risk and the taxpayers. A nationalized mortgage market is an unsustainable status quo, obviously, from a moral hazard perspective on this thing. And sadly, the situation we find ourselves in today was a predictable one. In 2003, I introduced legislation, and again in 2005, which would have reined in the GSEs, allowing them to be regulated at that time for systemic risk. Then Fed Chairman Greenspan backed the amendment, but it was not enough to overcome the outsized political pressure brought by the GSEs themselves. To be fair, you said last summer that this was not a normal issue on which the Fed would comment, but that we are in a now or never moment for reform, as there is not a current risk with a healthy economy now and the housing system. How long will this now or never moment last, and what are the consequences of inaction on this?
I think now continues to be a good time to move forward on this. It is one of the big pieces of unfinished business from the crisis. It is unsustainable to have effectively the U.S. housing finance system on the government's books for the long run, and it's not healthy. So, I don't know how much longer. I think we're going to need to address this. I assume we will at some point, and I would just say the sooner the better.
Let me ask you another question on this front. Chairman Greenspan often commented on the role of the GSEs in our economy. In 2004, in testimony before the Senate, he said, "Concerns about systemic risk are appropriately focused on large, highly leveraged financial institutions such as the GSEs to fend off possible future systemic difficulties, which we assess as likely if the GSE expansion continues unabated. Preventative actions are required sooner rather than later." Those were his words in 2004, ominous words, no doubt. Today, pressure is being brought on the administration to release the GSEs out of conservatorship. Although I oppose this move absent congressional action, I am hopeful that if this were to occur, there is no doubt today that Fannie and Freddie, given their size and role in the housing market, would be regulated as systemically important. Do you share this view?
So the form in which this reform takes place will, of course, be up to you, not to us, and it's not in our lane. I would say, I would really hope that that these institutions would not be systemically important at some point. I would think when we get to when you figure out a process that where they can be moved off the balance sheet, the idea would be that they would not present systemic risk, ideally.
Let me move to another question, Chairman Powell. Earlier this year, this committee passed legislation that would reverse a previous SEC rule requiring that certain money market funds float the NAV. I certainly remember when the Federal Reserve Fund broke the buck in 2008. I remember where I was when that occurred. And the massive backstop the U.S. taxpayers provided to restart the entire market as a result of this and other factors. The fact is that the value of the underlying assets of those products fluctuate. They go up and down. As I said in opposition to the bill at the time, if we learned anything from the financial crisis, it should be that the price should reflect risk. While understanding this is the primary jurisdiction of the SEC, and Chairman Clayton has already expressed his concerns, I was hoping as a member of the FSOC and as someone uniquely positioned to comment on macro financial stability that you could comment on any concerns with this potential move.
I very much share your concerns. This was one of the many critical weaknesses identified in our financial system during the crisis. We worked hard to address it, I think successfully to some extent, and I'd not like to see that undone.
Chairman Powell, I'm out of time. Thank you very much.
Thank you.
Gentleman's time has expired. The chair now recognizes the gentleman from Illinois, Mr. Foster.
Thank you, Mr. Chairman. Chair Powell, the last time that you were here, I discussed with you a policy of countervailing currency purchases as a response when a country has been determined to be a currency manipulator. I believe that my staff has transferred to your staff the ideas from the Peterson Institute on the specifics of how countervailing currency intervention may be an appropriate response. But I'm actually more concerned now about the currency manipulation than I have been. Obviously, President Trump has sort of recklessly now begun a trade war with many of our trading partners, particularly with China. I think many of the countries that are on their currency manipulation watch list that gets reported every so often by Treasury have been either hit or threatened by tariffs. Some of these countries are going to run out of gas in terms of the products that they can impose retaliatory tariffs on, at which point I think it is quite likely that they will resume currency manipulation that they've done in the past. And China is probably top of my list on this because they will run out of gas fairly quickly. And the damage that has been done in the past by Chinese currency manipulation is enormous, and one that many of my constituents have felt in their businesses. And so I think it is more pressing than now that we actually have a response in place, ready to go, if and when any one of those countries, in particular China, resumes currency manipulation. Countervailing currency manipulation is something that can be done. I think it's an appropriate response, and it can be done. And so I was wondering, has Treasury contacted you in any way with our suggestions that we've given to them on getting ready, having this take place? Because obviously a significant response would be a joint project between Treasury and Federal Reserve.
It is entirely, the currency issues are entirely up to Treasury. I don't know whether they've technically consulted with us about it or not. It's the first time hearing about it.
Okay. Well, yeah, anyway, so I encourage you to look into this. If you find that there's any legislative impediments to that, I believe the suggestion from the Peterson Institute is that if this goes forward, it would be a joint effort where the currency purchases would be jointly done by Treasury and the Fed. So it
would just be implementing their decisions, though. We wouldn't be making those decisions.
Correct, but it's something that I hope that we are prepared for, because the risk, if anything, of a resumption of significant currency manipulation has certainly gone up because of the Republican tariffs. And so okay, so I just want to flag that for you. Secondly, there's been some discussion in the previous testimony about wage growth and so on, and this plot that's up here. Did you see the article in the Wall Street Journal a couple days ago about how inflation is eating up workers' wage increases? Yeah, and this is essentially the plot from that shows that while workers' wages were out during the Obama era, workers' wages were modestly outstripping inflation. That's no longer true in the Trump era. That things like the massive tax cut for the wealthy and the deficit spending have driven inflation more than they have driven wages. As a result, for wage earners, the situation has not improved. That's in great contrast to the situation for CEOs and so on, who've seen their compensation go up way faster than inflation. And so I was. There was an announcement by the Federal Reserve, I guess a month or so ago, that the historic milestone of household net worth exceeding $100 trillion, which I think is a very, it was a very interesting milestone in the recovery. It's up from, I believe, around 55 or 60 $1 trillion during the depths of the crisis. And so it's a real milestone. But that is an aggregate number. And so one of the things we're seeing more and more is a divergence between average numbers, when you average in the results of the very wealthy, with numbers like this, which is the wages for wage earners, where the situation is very different. So what I'd like to urge you to do is, when you report, for example, household net worth, to report it not only as an aggregate, but as quintiles, or the top 1%, top 10%. And to report this on a quarterly basis the same way you report the aggregate number, I think it would really illuminate a lot of where our economy is going. And I'd like to see that in the next report and future reports, if that's possible.
I'll look into that.
All right. Well, thanks much.
Thank you.
Time of the gentleman has expired. The chair now recognizes the gentleman from New Mexico, Mr. Pierce, chairman of our Terrorism and Illicit Finance Subcommittee.
Thank you, Mr. Chairman. And Mr. Chairman, appreciate you being here today and your leadership on the economic front for the country. So you had given testimony yesterday or whenever to the Senate about the effect of opioids and the labor force participation rate. Can you kind of walk through that briefly for me?
Yes. Labor force participation by prime-age males has been declining for 60 years. It's been declining for females for maybe the last 15, 20 years in the United States. We stand out compared to other countries. So many things that happen in the economy are global. This is really something that we have. A significant number of those in their prime working years who are not in the labor force, close to half, I think in that one estimate was 44%, are taking painkillers of some kind, which is the opioid crisis to some extent. So there are many, many people who are out there in their prime working years, not in the labor force. We'd all be better off if they were in the labor force, including them. And part of the reason they're not is the drug issue.
The problem is especially egregious in much of New Mexico, and so we've passed a series of bills here that are directed at beginning to stem that problem. Have you looked much at the legislation that we've passed through the House? Anything that stands out as being especially effective in your ideas or the ideas of the committee?
You know, I haven't looked at it carefully. I did see that, but I'll be happy to go back and look.
Okay, yeah. Now, for New Mexico, we have a little bit of an aging population, and we also have lower income population. That all argues for less complexity in the investments. And so typically they would like safe investments, but then the interest rate is always at such a low rate that it's driving unsophisticated investors into sophisticated items seeking rates of return. Any ideas how we can help out our seniors who typically fall in that category? I'm thinking about my mom, the last few years of her life. She just wanted not to lose money and just to have it safe. And yet we're seeing a lot of seniors chasing rates of return and getting into a very unsafe thing. Then they lose their nest egg. So how's the Reserve looking at that?
You know, as you know, we're not responsible.
Yeah, if you could speak a little bit more directly into the microphone, I'd appreciate it.
Sorry, we're not responsible for investor protection, but we kind of are responsible.
No, but it's the rate of return.
Rates.
It's the rate of return on simple investments, the rate of return on passbook savings or money markets. That's the question.
Right. We've kept rates low for a long time, and we think that's had a very positive effect on the economy. It's boosted employment. It's boosted activity. I think it's definitely been tough for seniors who who are really relying on their passbook savings, for example, for interest. But overall, for the economy, it's been a good thing. And you know, rates are going up now because to reflect the strength of the economy. So that should be helping some.
Yeah. As we talk about the labor force participation rate, we're also noting a lot of skill atrophy. People who've been on different public assistance programs for some time actually don't have much skills. So as the President talks, he talks about the apprenticeship programs. Have you all taken a close look at how the apprenticeship programs could be directed at the people who've been out of the labor force, not the people in the high schools, but the people who have been on the sidelines for some time? Are there any studies available to us on the effectiveness of those programs?
Yes, we have an excellent group of labor economists, and that has been a particular focus, I know. So we would be delighted to supply that to you, discuss it with you or your staff, we'd be happy to work with you on that.
The energy economy that you reference in your report a couple of times is one that's playing out in the southeast part of New Mexico. Some of the largest finds and most productive wells being drilled are occurring right there. The pipeline capacity is becoming a choke point, and then also the refining capabilities. So we're suggesting building a refinery in New Mexico and asking for White House help to get the permits done. All of that would help us to become energy self-sufficient. Thank you, Mr. Chairman. Yield back.
Time of the gentleman has expired. The chair now recognizes the gentlelady from Ohio, Ms. Beatty.
Thank you, Mr. Chairman, and thank you, Ranking Member, and thank you, Chairman Powell. Good to see you again. I just have a couple quick questions I'm going to try to get through. Mr. Chairman, I brought the Federal Reserve supervision and examination of insurance savings and loan holding companies up previously with Federal Reserve Governor Quarles, and my staff brought this topic up with the Fed staff on several occasions. Since the economic crisis, a number of insurance and saving and loans holding companies has dwindled from some 30 to just 11, according to the Fed's 2017 annual report. I have 2 of these insurance companies in my district, which employ thousands of people, and one of them just announced that they are closing their depository institution. While I understand that there are several business reasons for an insurance, savings, and loan holding company to close their own depository institution, there is little doubt that one of the factors why they are closing them down is due to the burdensome and inefficient supervisory regime by the Federal Reserve. I have worked with my colleague on the other side of the aisle, Mr. Rothfuss, to introduce legislation that would force the Federal Reserve to tailor their bank-centric regulations to those to insurance companies, which are wholly, as you know, different from banks. While I think there should be some cost of admission for an insurance company to own a depository institution, I don't think that cost should be so high that it makes no financial sense to own one, which is where I think that we're headed. Do you think that this problem that these insurance companies are closing their banks, that this is part of the reason, or is it the Federal Reserve's desire for no insurance companies to own a depository institution?
It's certainly not our desire to drive anybody out of owning a bank who can legally own a bank. I think in the case of depository institutions that are owned by insurance companies, our interest is in the safety and soundness of that depository institution. So we work very carefully not to duplicate the insurance regulatory work that the state insurance supervisors capably do. But we have a role to play as the holding company supervisor as it relates to the depository institution. And that's what we care about. That's really all we care about. And I think, you know, my recollection, these companies are getting out of owning depository institutions mostly for business reasons as opposed to for regulatory reasons. In any case, we're committed to doing that as efficiently as we can. And
are you familiar with our legislation?
Yes,
Is it something that will be helpful, or do you have an opinion?
So we've raised concerns. The concern that we've raised is that we would be effectively out of the business of supervision at the holding company. We would promulgate standards, but they would be supervised by the insurance supervisor. And the insurance supervisors, they do a fine job of supervising insurance, but they're not prudential regulators of banks. And we think if you're going to own a bank, you should be subject to regulation by a prudential regulator of banks, which would be us in this case.
But you'd be at least willing to kind of see if we could tweak it or work together,
Absolutely,
maybe?
absolutely.
Okay. Thank you. On another good note, let me also say thank you for being very responsive to our letters to you from the Congressional Black Caucus and from me on diversity. I really appreciate that. As you'll probably recall, we've had several conversations about the Beatty rule that's patterned after the Rooney rule. If you're looking for minorities, and more specifically African Americans, to serve on the Federal Reserve, then you have to put them on the list. You have to include include them in the room. So while we weren't necessarily overjoyed with the last appointment, I am pleased that Mr. Bostic is there, and just hoping as more openings come that you'll keep that in the back of your mind. Lastly, I have kind of an odd question. I was on my way back to Washington. I stopped in a restaurant, and a gentleman came up to me and chased me down and said, I know that Mr. Powell's going to be coming before your committee. Would you ask him this question? Well, we're going to kind of paraphrase it because my team wasn't quite sure what he was asking, and he stated it more as a fact. But I think what the constituent was asking me, and he stated it more as a fact than a question, but he essentially wanted me to ask you whether or not you believe the Federal Reserve's monetary policies exacerbates the wealth inequality in our country. I think for some reason he felt that organizations who receive the interest payments on our national debt is destroying the middle class.
No, we don't think monetary policy is exacerbating inequality. We think, in fact, it's helping those who didn't have jobs get jobs, and so those are the people who need those jobs.
Thank you very much. And
Time of the gentlelady has expired. The chair now recognizes the gentleman from Florida, Mr. Ross.
Thank you, Chairman. And Chairman Powell, thank you for being here. Your predecessor, from whom I had a great deal of respect, I know struggled for some time with regard to the impact of the quantitative easing, the low interest rates, the high unemployment. And I see that based on your report today, the outlook is much brighter and doing much better. I echo my concerns of my colleague, Mr. Pierce, because I have a great deal of retirees in my community, and they want to start seeing some return on their investment, of course, instead of having to keep dipping into the principal of their savings. Chairman Powell, it's been more than 9 months since the Federal Reserve had its first official vice chair for supervision sworn in. As you know, prior to Vice Chair Quarles taking office, the responsibilities of his position were unofficially shared between former Fed officials to such an extent that it was never really sure who was in charge of regulatory affairs at the Federal Reserve. As a consequence, it felt to many of us in Congress that the divide between the Federal Reserve's regulatory responsibilities and those related to monetary policy wasn't as explicit as it should have been. Further, there seemed to be a high risk that Federal Reserve regulations were not being given the necessary oversight and evaluations. There were more and more regulations coming out. And now with the position filled by Vice Chair Quarles, I'd like to hear if things have changed at the Federal Reserve. Do you find that having a Vice Chair for supervision has allowed you to focus more on monetary policy, the side of the Federal Reserve's work? In other words, does it help prevent inappropriate overlap of the Fed's roles? Now that you've got distinguished supervisory roles in the Fed.
Yeah. Let me say it's great to have Vice Chair Quarles in his role, and I know he was confirmed yesterday into his underlying governor term. It's terrific. I've worked with him. I worked with him 25 years ago, so he's been great. We think of the roles as pretty complementary, actually. We think that essentially the financial system more broadly and the banking system is the transmission channel for monetary policy. So we think we learn a lot about what's going on in the economy and also about how monetary policy is getting out into the economy by virtue of the fact that we're in supervision. We do have a separate division that takes care of all that, and Vice Chair Quarles, as the Vice Chair, has particular authorities under the statute to recommend policies to the board, that sort of thing. I hope I'm getting to your question.
Yeah, but as I mentioned, I think the past 10 years we've seen the financial, as a result of the financial crisis, we've seen new regulatory schemes being imposed, and it seems to me that now would be an appropriate time for the regulators to take a step back and conduct, let's say, a holistic review of the impact of these regulations. And I believe that having Vice Chairman of Supervision renders this holistic view more appropriate at this time. I mean, do you think now would be a good time for such a review?
It is a good time, and in fact, we're doing that. We're committed to sustaining the important post-crisis regulatory reforms, higher capital, higher liquidity, stress testing, resolution. We're also committed to looking at everything that we've done in the last 10 years and making sure that it's right-sized and effective.
Has your review revealed any duplicative or burdensome regulations that could probably
be done away with at this point?
Yes, I think we're finding quite a lot to do, mainly as it relates to smaller and medium-sized institutions, which where I think there's quite a lot of good work that we can do on that front.
It's also part of your report. You note that residential investment has leveled off for the first 5 months of this year, and that's a little disappointing to me because I think that's a leading indicator for us in terms of residential investment. When I go home to Central Florida, I can see skyrocketing demand for homes, but for some reasons, developers just can't keep up. One of the things that you've talked about, and I think that Mr. Pierce talked about also, is the, quote, tight supply of skilled labor. Can you expand on that? I mean, how long have we been approaching this tight supply of skilled labor? My concern is this, is that we have a great tailwind behind us right now. We've got a 4% GDP. We've got lower unemployment than we've had in a long time. We've got more capital than we've seen before, but yet if we're not going to have the economic recovery because we don't have a labor market, what's in store for us? And how can we best address this labor market shortage that's facing us?
It's a real challenge. You know, you plumbers, carpenters, electricians in short supply. A lot of people left the industry after the crash. Now there's a need. Also, it's very hard to get lots. I mean, it's difficult. The zoning and everything is quite difficult.
The training programs.
They're also facing, you know, high materials prices. Right. The big.
Which is a component of it too. But even if we have to have the labor is what I'm getting at, and even if we have to import the labor, we need the skilled labor.
So I think you're right. There's a good question about how the economy will absorb all of this momentum, and I think the tools to expand the labor force are really not ours. They're really yours.
I agree. Thank you. I yield back.
Time of the gentleman has expired. The chair now recognizes the gentleman from North Carolina, Mr. Pittenger.
Thank you, Mr. Chairman, and thank you, Chairman Powell, for being with us. I really want to commend you for taking the initiative to provide time to be with members and for allow those discussions to occur. I think it's very helpful for us. Mr. Chairman, as I understand it, is your directive to promote stable prices. Some of your policy committee members have expressed interest in replacing the current inflation target with different target measures that would provide even greater variability. Given that, would you help me just better understand the difference between price stability and stable prices?
I think they mean the same thing. I wouldn't say there's a big difference there.
Good. Well, thank you. That clarification helps. In this year's monetary policy report, you state that the labor force participation rate has been in decline for decades and has seen a recent increase among prime-age individuals. Despite the factors that continue to cause the decline persisting, you have said that the continuation of the increases seen over the past few years is possible if favorable labor market conditions continue as well. Have you seen these favorable labor markets, at least more recently, remain or even show increases since the passing of the Tax Cuts and Jobs Act?
We do see the labor market continuing to strengthen, and as you point out, labor force participation by prime age males and females has kicked up in the last couple of years. That's a great thing to see, and we really hope those gains are sustained against a longer run trend of decline. But we hope that this is a great chance for people to get back in the labor market, and we hope to stay there.
Would you draw any correlation between the Tax Cut and Jobs Act bill and that dimension?
I think that there are a variety of things contributing to this. Certainly, the business tax cuts are helping support activity, and the individual tax cuts too.
How have the Tax Cuts and Jobs Act affected your current monetary policy?
Sorry, I missed that.
How has the Tax Cuts and Jobs Act affected your current monetary policy?
It's hard to single out an effect. We really look at many, many different things. The economy is strong, and we're on a path of gradually raising rates. And I think that reflects kind of all of the things that are going on, including the changes in fiscal policy.
Yes, sir. With the new tariffs coming from both at home and abroad, some businesses are shying away from both capital and labor force investments. The report states that net exports had increased in the second quarter, led by agricultural exports. Do you see this changing, especially in light of the retaliatory tariffs on numerous agricultural products from Canada and the European Union?
I'm sorry, the last.
Do you see this changing in light of the retaliatory tariffs coming from Canada and the European Union?
I think there's a lot of uncertainty about how this round of discussions between us and essentially all of our major trading partners will come out. I think if it does wind up in a lot of reciprocal tariffs, then it would certainly affect our exporting industries, including, in a big way, U.S. agriculture. So it's a risk.
Yes, sir. You previously stated that the U.S. financial system is substantially more resilient than the decade before the financial crisis. Should there be a trade war, what tools do you have to move quickly to ensure this continued resiliency and economic growth?
I think the financial system is well capitalized and so much more strong and resilient in so many ways that it's there in a position so that it can resist or be resilient against shocks of various kinds, and that would include changes to trade policy that became disruptive. I think our monetary policy tool we can always use to it really relates to demand. So if demand weakens, then we can support demand. I mean, the harder issue is you could be seeing higher prices because of tariffs. At the same time, you're seeing, lower economic activity, and potentially that would imply higher inflation. A mere increase in tariffs wouldn't mean necessarily higher future inflation, but if it did have that implication, it could be very challenging for policy.
Thank you. My time has expired.
Time of the gentleman has expired. The chair now recognizes the gentleman from Pennsylvania, Mr. Rothfuss.
Thank you, Mr. Chairman, and welcome, Chairman. I want to talk a little bit about the automatic SIFI designation being set at $250 billion in S2155. This was an important change that right-sized the regulatory burden for a significant number of small and medium-sized institutions. In setting the threshold at $250 billion, however, we grouped large regional banks together with banks that have assets in excess of $1 trillion. These institutions do not only differ from each other in terms of size, they also differ in their levels of risk and complexity, as well as their capital structure and their business mix. Would you agree with that assessment, that there is a distinction between those large regional banks and those other banks?
Very much so, not just size, activities as well.
Given this distinction, how will the Fed be tailoring regulations for banks above the $250 billion threshold?
Working on a framework now. Some ways away from publishing it, but it'll take into account a range of factors, including size will be one, but also many others such as complexity, interconnectedness, the nature of their activities, all those. We'll take in a wide range of factors. The bill gives us a great deal of flexibility to identify the appropriate factors, and we're just in the process of doing that. We're going to put that out for comment and listen carefully to public reaction to.
Any time frame yet on when that might happen, comment period?
I can't be precise. Well, I'll just tell you we're working hard on it right now.
Okay. When Secretary Mnuchin testified before this committee, I asked him about an issue that many of us on this committee have expressed concerns about, non-bank SIFI designations. I've advocated for an activities-based approach to addressing systemic risk. I was pleased to hear that Secretary Mnuchin also supported adopting this approach and that the FSOC was moving in that direction. Do you support an activities-based approach?
Yes, I think that makes sense.
What would be the status of FSOC's implementation of that approach?
Really a question for the Secretary, but I think that's more how we're looking at things these days, is looking at activities, as well as we can always look at institutions when it's appropriate. But for now, we're looking at a lot of activities.
If I could talk a little bit about the yield curve. The inversion of the yield curve is typically viewed as a sign of a coming recession. The yield curve is currently flattening, and this has attracted a lot of attention. In a recent post, Minneapolis Fed President Neil Kashkari wrote, quote, "This suggests that there is little reason to raise rates much further. Invert the yield curve and put the brakes on the economy and risk that it does, in fact, trigger a recession." Do you agree with this view?
I don't see any evidence that a recession is imminent. We're not forecasting a recession, and so I don't really think we see a recession coming.
Do you have an opinion on how strong of a signal the yield curve inversion is?
So the inversion of the yield curve has been just as an empirical matter, it's been associated with downturns in the past. But I would just say the real point, I think, is a yield curve inverts. We know why short-term rates go up, because basically they're looking at the Fed's expected rate path. The real question is what's going on with longer-term rates, and if you back out the term premium and look at that, then it's really an assessment in the market of what the neutral longer-term rate is, what it'll be. So if in fact monetary policy is higher than that, then that means that policy is tight. You're actually tightening policy. So the yield curve is simply a way to identify what is really the important thing, which is where is current policy and where is expected policy relative to neutral. So I prefer to look directly at the question at hand, and you think about the yield curve as giving you evidence on that. So the yield curve is not inverted now. It's still at a positive slope, and it's something, you know, that we'll watch. All of us have a little bit different ways of thinking about it. That's how I think about it. It's something we're looking at carefully.
Great, thank you. When you last testified before this committee, we discussed the importance of monetary policy independence and potential risks to that independence posed by both our national debt and the Fed's outsized balance sheet. Would swapping mortgage-backed securities holdings for treasuries help to mitigate some of the political risks that follow from monetary policies becoming credit policies?
I don't see our MBS holdings as, you know, they're dwindling over time now. They're in normalization mode. I don't see them as presenting, you know, particularly salient independence risk to us right now.
Thank you, Chairman. Yield back.
Gentleman yields back. Chair now recognizes the gentleman from Maine, Mr. Poliquin.
Thank you, Mr. Chairman, very much. Thank you, Chair Powell, for being here. You've been here, sir, for almost 3 hours with a 10-minute break, and you look like you need a vacation. I want to remind you that Maine, that I represent, is vacation land. You don't even need air conditioning up there, and I'm sure you and your family would enjoy it. If you want to go up there, just give us a call. We'll send you in the right direction. Sir, the past couple of years, the economy's been getting stronger and stronger, and you mentioned in your testimony that the national unemployment rate's been about the lowest it's been in 20 years. Up in Maine, we have also good news. The unemployment rate's roughly 2.8%. It's been the lowest in about 50 years, and folks are making more money, and they're able to change jobs if they don't like the one they have. And some of our young workers are able to come back to the state, whereas in the past they haven't been able to. And our confidence with our consumers and our small businesses is all very strong. Now, if you look at the prior 7 to 8 years, the exact opposite was going on. Unemployment rates were very high, confidence was low, taxes and regulations were high, and we had a real problem everywhere. Now, my point to you, sir, and if you would agree with me, that this strong economy we have now is not by accident. It didn't fall out of the sky. There's something that had to be done to correct this. Would you agree with me that making it easier for businesses to grow and hire more people and pay them more through lower taxes and fewer regulations, and more predictable regulatory environment has helped the economy?
Yeah, I guess I would just say, in principle, that regulation should be balanced.
Sure.
And should be fair, and that will support.
Yeah, anybody that's run a business, and I come from that part of the world, sir, you know, would agree with that, and I appreciate it. I know you don't want to dig into policy that we do here, and I understand that. One of my concerns, my major concern, Mr. Powell, is how do we keep this going? How do we keep this going for our families in Maine and elsewhere? I look back at the last few recessions. In 2001, we had a bubble in the dot-com sector, the tech stocks, and that caused a recession. The terrorist attacks in 9/11 caused a mild recession. After that, that's an external event that, you know, we can't control here anyway. And then in the 2008 to 12 Great Recession, again, a real estate bubble, in part brought on by financial instruments that dealt with the real estate market, brought that on. So I think we can both conclude that what happens in the capital markets, what happens in the financial sector, has a huge impact on what happens on Main Street when it comes to a growing economy or the other way around. Now, here's my concern, Mr. Powell, and I'd love to have your response to this. During the past 10 years, for most of the past 10 years, interest rates have been very low, in some cases at zero, unusually low. And that's caused a rising financial sector, whether it be the equity market or the fixed income market. So I'm looking and I'm saying, here we have the chair of the Fed before the Committee of Jurisdiction in the House. What advice can you give to Congress, Mr. Powell, to make sure that we keep this strong economy going? What should we make sure we do not do?
Well, let me say we strongly share your goal to keep this expansion going, and we think that continuing to gradually raise rates for now is the right way to do that. As I think we discussed when we were together, I think it's important to address things like we talked about earlier, things like labor force participation, things like education and training. We need people. You know, we need more people who can fill these jobs that are going to be coming open. And I mean, my concerns are not so much are really about the supply side at this point. You know, we're close to full employment, maybe not quite there, but it's the issues like labor force participation and job training and addressing the people who are out of the labor force, get them back in.
There are some folks that think we ought to raise taxes and go back to where we were before. Is that a good idea?
You know, I'm not going to give you advice on fiscal policy. Sorry.
Okay. The national debt, and pivoting a little bit, Mr. Powell, is about $21 trillion. It is horrible. The interest on that debt now is approaching roughly $300 billion per year, which is about 1.5 times what we spend to care for our 7 million veterans every year in this country. At what point do you think the debt service payments, the interest on that debt, becomes a problem for our economy?
It's hard to identify a particular point. I would just say we've been on an unsustainable fiscal path for some time, and you know, the theory is we should be addressing it when the economy's strong.
Do you agree with me that a balanced budget amendment to the Constitution is a good idea to force Washington to spend within its means and start paying down our debt, sir?
No, I do not.
Thank you, Mr. Chairman. You're back my time.
Time of the gentleman has expired. The chair now recognizes the gentleman from Minnesota, Mr. Emmer. Gentleman from Minnesota.
Thank you, sir. I thought I was going in a different direction. My apologies. Mr. Chairman, it's, again, a pleasure to have you here and have an opportunity to hear you and speak with you. For starters, I'd just like to make a brief comment about tailoring regulations. I mentioned the importance of taking a tailored approach to financial regulation when you appeared before our committee in February, but that was actually prior to the passage of the Economic Growth, Regulatory Relief, and Consumer Protection Act. Eliminating the one-size-fits-all regulatory mindset for small community financial institutions is obviously important. However, S-2155 was explicit in its requirement that federal regulators shall tailor enhanced prudential standards for all financial institutions based on their risk instead of asset size. This is a very important issue, and I hope that we can keep an open and constructive dialogue on this issue in the weeks and months ahead. Again, for us, it's the issue of risk versus asset size. And I see you're nodding, so hopefully that means we are going to keep a constructive dialogue about how you approach it.
We look forward to that.
Moving on, Chairman Powell, your committee initiated a balance sheet roll-off less than a year ago, October of 2017. During your, shortly thereafter, during your confirmation hearing, you testified that balance sheet reductions would likely stay in place for, quote, about 3 or 4 years. I understand, however, that now some FOMC members are already calling for an early end to what has been a seemingly slow balance sheet normalization schedule. Are you considering a premature end to your balance sheet roll-off program?
No, but let's be clear. We've always said that there's significant uncertainty about how long it will take. Ultimately, the balance sheet will be no larger than it needs to be for us to conduct monetary policy. It will consist primarily of Treasury securities, and its ultimate size in the long run will be driven by the market's demand and the public's demand for our liabilities, principally currency and reserves. So we're learning, along with everybody else, as the balance sheet shrinks, as to what the new normal will be. And I have to say there's a significant amount of uncertainty. We'll learn a lot. You know, the markets are moving their estimates up, but I don't think we're going to know for some time exactly what that equilibrium size will be. It'll be much bigger, though, than it was before the crisis because the public wants more, currency in circulation more than doubled since 2008, well more than doubled, and reserves have gone up substantially because they're a highly desirable liquid asset for banks.
All right, but at this point, there's no plan to prematurely end the roll-off.
Certainly not prematurely, no.
All right. The European Central Bank is reportedly convinced that the region's economy is strong enough to withdraw some of its crisis-era support. Our economy, by contrast, has been humming for more than a year. If the EU is lifting off from its unconventional stance, should we be slowing or stopping a return to fundamentals? And would doing so leave us stuck with a balance sheet that remains conflicted between monetary and macro-prudential policy?
You know, we're much more significantly down the road in the normalization process. The European Central Bank has said that they would stop asset purchases, assuming certain conditions are met by the end of the year, and would not begin to raise interest rates until at least the end of the summer of 2019. So they're some years behind our process. We've been raising interest rates since December of 2015. Right. Our balance sheet's been shrinking, as you pointed out, since last October. So, and I think we think our path is working very well. We think the gradual rate increases are right, just about right, and we think the balance sheet normalization process is working very smoothly.
Has your committee devised a strategy for how and when to change the balance sheet roll-off schedule? I mean, I'm taking you down this because I understand your answer earlier is there's a lot of uncertainty and we learn as we go, but what's the strategy, or is it just that general, that we're just going to see how this goes and we're going to leave ourselves the flexibility to jump in and change things?
So we said we would continue the program as announced unless there were, I won't get the exact terms, but it will be, it's really a significant economic downturn requiring a meaningful reduction in interest rates. Words close to, but not exactly that.
I don't know if you'll have time, but I do want to ask this. Do you think, Mr. Chairman, that market participants have the transparency they need to make productive investments in our economy? And what data would persuade your committee to speed up, slow down, or even stop?
A significant reduction, a significant downturn in the economy that required meaningful reduction in interest rates. I think the markets understand it very well.
Time of the gentleman has expired. The chair now recognizes the gentleman from Washington, Mr. Heck.
Thank you, Mr. Chairman, and thank you, sir, for being here. So for over a year now, I've been helping to lead a task force trying to understand why home prices and rents well, frankly, are soaring all over the country. And it turns out the answer is pretty simple. We're not building enough housing units, period. I looked this morning, and as it turns out, new home starts are lower than when you started at Treasury under the first President Bush. And a lot of time has passed, and the population has grown considerably. Fewer home starts than way back then. So prices are rising because of simple fact that we're missing millions of homes, and we have too many people bidding for too few homes. And we're trying to understand why construction isn't happening and what can be done about it. We feel pretty strongly about this because home ownership is still an integral part of the American dream, and frankly, it's the #1 source of retirement security for most Americans. But it also strikes me that it's pretty important to your work, sir. Now, in my mind, I have kind of a simple model. When the economy goes bad, you all cut rates, and that means that more people buy more automobiles and more homes, and the workers in those industries work longer hours and get more wages, and it creates a virtuous cycle of economic growth. But what happens if home construction doesn't or can't respond? The weakness in housing in this last recovery was clearly a reason why it was at historic, some would say anemic, levels. And if home construction continues to be broken, and there's every bit of evidence that it is, I'm wondering what that means for the next recession and what your response can and should be. Does it mean you have to cut interest rates even more aggressively to get the economic response? Because it didn't seem to work out very well that way this time.
So you're right. It's those back in the day, it was nothing to see. Well, it was common to see 2 million housing starts in a year and more, and we don't see that now. And part of that is just the population's growing a lot more slowly now, much slower than it was. So there's less demand. And I'm sure you talk to a lot of home builders and their representatives in your work, and what they say now is there's really supply-side constraints. They can't find electricians, plumbers, carpenters, and also it's hard to get zoning, it's hard to get lots, very, very difficult to do that. They're also, they're yelling loudly about materials prices, lumber in particular. And so what they're doing is they're building fewer homes and the prices are going up more quickly. We don't really have the tools to deal with that. In terms of the importance of housing, though, the economy is so much bigger than it was before, and housing is smaller than it was before. So it's a less important driver of economic activity at the aggregate level. It's still tremendously important for individuals. I mean, it is still part of the American dream and part of what, you know, young families and folks want to have. So, but I don't think it has, it doesn't have, it's not the single most important factor driving monetary policy right now. I think these issues are really issues of, you know, issues out in the labor market that we don't directly affect.
So, would you agree, however, that historically, housing construction has been played a much more important role in economic recovery?
It was a far bigger part of the economy, and it can be very cyclical. So yes, if you go back to the 70s and 80s, it was, you know, sort of first in, first out, first into recession, first out.
And before, during recoveries, and if you do the math on what the increase in GDP growth would be, if we simply had a housing market that was in balance, then it wouldn't be too hard to calculate a material increase in GDP growth. Would you agree with that?
It would be bigger. I mean, if the housing market, if housing starts were 50% higher or something, yeah, that would be meaningful for sure.
So some of what you said, not only do I agree with, but our study concludes as well, which is that these other inputs, land, labor, lending, lumber, or materials, are the key drivers here. But the takeaway I have from you today is that those inputs and whatever limitations and challenges that they are presenting that is holding back housing construction may in fact be immune to interest rate reduction, and so we better get to work on those factors.
Well said.
Thank you, sir.
Time of the gentleman has expired. The chair now recognizes the gentleman from Illinois, Mr. Holmgren.
Thank you, Chairman Henseling. Chair Powell, welcome. Glad you're here. I'd echo much of what my colleagues have said on both sides of the aisle of our gratitude for your openness and willingness to meet with us and to hear from us, and that's so affirming. So thank you very much and appreciate your work. I have shared some very specific concerns with you about how our current risk-based and leverage-based capital rules are damaging to liquidity in the listed options markets. As you know, Title VII of Dodd-Frank requires central clearing for derivatives, and in case of options, this service is generally provided by bank clearing members. The Financial Services Committee reported a bill with unanimous support, which recently passed the House, directing bank regulators to adjust the capital rules. However, as I understand it, no change in law is necessary for the Fed to provide targeted capital relief. I wonder if you've thought any further about how the Fed can address this issue in an expeditious manner, and do you believe SACR can be implemented within the next 8 to 12 months? I understand that there's not even a proposal out for comment yet, but we have an issue in the options markets right now.
We think SACR is good policy, and we're working on a rule on it now, and I hope it can get out before 8 or 12 months. I'll go back to the office and check in, but it's a priority. I know there's actual drafting going on and negotiation between agencies, so it'll happen.
That's perfect. That's what we want to hear, and again, I think you can see from even just the action yesterday and in the last couple of weeks of very strong bipartisan support to make sure that these markets work well. I sent a letter to financial regulators with responsibility for the Volcker rule back just a couple weeks ago, July 6th, requesting that they reconsider the definition of covered funds. That definition currently excludes venture capital. As my letter states, the congressional record clearly demonstrates through a colloquy between Senator Boxer and then Chairman Franks that investing in venture capital was never intended to be prohibited by the Volcker rule when Section 619 was drafted by Congress. This prohibition restricts access to capital for startup companies. wonder, do you believe the Volcker Rule should be amended in a way that ends this prohibition on investment in venture capital? And have you discussed this issue with your peers at the other financial regulators? And any thoughts on odds that there could be change made here?
I'm not directly handling those discussions now, but you know, we've put a draft out for comment, and we're hearing on this point a lot, I believe, and you know, although I guess the comments haven't really come in yet, but in fact the comment period hasn't started running yet because we haven't published the notice. But our idea is that these activities are not ones generally that threaten safety and soundness, so consistent with the letter and intent of the law, we want to allow what flexibility there is, and you know, we look forward to getting input on how we can do that.
Great, thanks. I recently sent your office a letter that I hope will draw your attention to the growing issue of wire fraud. This is something that we've heard testimony on in the Financial Services Committee last year. In general, since reviewing my letter, I wonder if you have any ideas for how to prevent wire fraud, and have you considered any recommendations, maybe some that I'd made, of having financial institutions apply a payee matching system when initiating a wire transfer?
So we appreciate your letter. I was looking at it again this morning, as a matter of fact, and we're putting together a nice response. Some of the data in your letter is quite alarming, so we appreciate your bringing that to our attention.
Great.
So we'll come back to you with something in detail on that.
That's great. Thank you so much. And if there's anything else you need from us or that we can be helpful, again, I think it is something that's so important for that confidence, especially in home purchases and things, that is being abused right now. Last question, the last minute here, and a lot of my colleagues on both sides have talked about this, but over the last 18 months, by almost every measure, we have had a very strong economy and taken appropriate actions to allow this momentum to continue. We've seen boost in consumer and business confidence following the recent tax cuts and continued regulatory relief efforts. That said, there are certainly issues that Congress must continue to address, like better training of our labor forces to meet labor demands of our expanding modern economy. I wonder, do you have concerns that protectionist trade measures may generate headwinds that counteract the recent stimulus provided by Congress and the administration? And do you believe a trade deficit is somehow a measure of whether the U.S. is winning or losing in the global economy? In other words, do you believe trade is a zero-sum game?
We have these discussions going on with basically all of our major trading partners, NAFTA, the EU, China, and we're not responsible for those. We're not even a participant. We're not consulted in any way. But you know, it would be good if they resulted in lower tariffs broadly. If they result in higher tariffs, higher trade barriers, then that'll be a bad thing for our economy, for our workers, and for incomes.
Thanks, Chair. I yield back.
Gentleman yields back. The chair wishes to inform all members that I will be excusing the witness at 1:30. I anticipate clearing 4 more members. Currently in the queue is Mr. Gottheimer, Mr. Loudermilk, Mr. Davidson, and Mr. Budd. The chair recognizes the gentleman from New Jersey, Mr. Gottheimer.
Thank you, Mr. Chairman. Chairman Powell, thank you for being here today. Our economy, as you know, is entering a phase of increasing technological disruption, including automation through artificial intelligence. These factors are expected to eventually increase our productivity, but also to significantly affect our workplace. McKinsey recently issued a report on automation and jobs that projects 16 million to 54 million Americans will have to find new occupations by 2030, depending on how quickly technology is adopted. If you take the taxi industry as an example, the use of ride-sharing apps have devalued assets like taxi medallions and transformed that industry. It's pushed some drivers out and brought new entrants in. And as tech companies strive for more automation and leverage artificial intelligence, more drivers will likely be pushed out or transitioned. AI and automation will have the same effect on other spaces like trucking and trading and a host of other industries. And I believe in tech, and I obviously don't believe we should become Luddites. We need to look toward the future and constantly innovate. It's a big competitive advantage for our country, and obviously our foreign competitors are doing the same. I believe our government needs fiscal and monetary policy to ease the transition, or at least be aware of it and understand what we need to in this process. And the Fed's monetary policy is obviously a blunt tool, but given your dual mandate, are you monitoring automation's impact on productivity and our labor, and what tools are you considering in this transition, sir?
So we look very carefully at those issues. We have great researchers at the Fed. We don't have a lot of tools to deal with it, but they do present really challenging issues for us in the future and now.
Are there things that you believe that Congress should be considering to help minimize the effects of these transitions or make sure we're prepared for, as a workforce?
Well, I think, you know, when I graduated from college, I think there was this sense that people would find a career and find an employer, and many of them would spend 30 years at that employer. I think that's not the world we're in so much anymore, not that some people won't do that. So I really think the idea that education ends when you get out of college or grad school, we need to be thinking a lot about mid-career training and education so people can go on and have another leg to their careers rather than being kind of let out to pasture at age 40. So I think that's a key thing we need to be doing, and Congress can certainly play a role there.
Thank you, sir. And just to switch topics slightly, and I appreciate your response there. On the housing front, I want to speak to you about the market a bit, specifically the change we've seen in the Federal Housing Administration's insured loans, but also the market as a whole. The mortgage market is now dominated by non-bank lenders. They're upwards of 75% of FHA loans. Prior to the housing crisis in that frothy area, this number was flipped on its head. Banks made up more than 75%, if not more, of the housing market. What risk do you think this presents as the credit cycle turns? That's my first question, if you don't mind.
So in housing now, we do see that most of the borrowers now have much higher credit scores. So it's a very different market. The question is, was that line drawn at the right place? But it's clear that most of the people who have access to mortgage credit now are people with fairly high credit scores. So it is quite different, and that's where the household borrowing is again from those who are well.
So you think if there's a downturn, we're better prepared for it?
We're better prepared for it. Yes.
Are there things that you think, as you look at this, that Congress should be doing to get banks back into the mortgage market more to ensure lending during economic downturns, looking forward there?
Well, I think a good question for Congress is, and this is not one for us but for you, is, coming out of the crisis, the one place where we really changed credit availability was in mortgages, and that had to be done, right? So because we know that mortgage credit was people were making loans that they may not have understood, but that really shouldn't have been made, lots and lots of those. So, the question is, was that made at the right level? Are there still, at the margin, and there's been some work done on this, there were probably significant numbers of creditworthy borrowers who are not getting access to mortgage credit. And I would think, part of it is that the banks know that they made these terrible mistakes and paid big prices for it, and so do the households. Still, I think it's worth looking at that. It's not too soon to be looking at that.
I think you're right. Thank you, Mr. Chairman. I appreciate your time.
Thank you.
Gentleman yields back. Chair recognizes now the gentleman from Georgia, Mr. Loudermilk.
Thank you, Mr. Chairman. Chairman Powell, thank you for spending the time with us today. I actually want to circle back to something that Chairman Lukemeyer raised earlier today, and since that was probably a couple of hours ago, refresh. He was talking about the banks that fall between the $100 and $250 billion in assets, and how after the 18-month period they are relieved from SIFI regulation. And of course, after that, the law allows the Fed the ability to restore the regulations if the bank shows to be a systemic risk. But regarding current conditions, recent CCAR results and GSIB's surcharge risk data show that banks with less than $250 billion do not present a systemic risk at this time. And I, as well as many others, believe that there should be exemption from the SIFI regulation for those. So I'm going to follow up that when you testified back in February, I had asked similar questions, and you had said that banks under $250 billion are more engaged in traditional banking and less complex and generally do not pose a systemic risk to the economy. So my first question is, am I correct in assuming that since the CCAR results further confirm your view that these firms don't pose a systemic risk at this time?
It's interesting. As a general matter, yeah, actually one of the 8 SIFIs has less than $250 billion in assets, and is still a SIFI. One of them does because of the nature of its activity. So we look at a range of things. I would stand by what I said, though. With under 250, these are institutions which generally they're simpler, they're less complex, and they're engaged in traditional banking activities. So they're different from the very large ones that deserve and get the higher scrutiny.
Okay, well, I appreciate that. And at yesterday's hearing, you discussed a thorough rulemaking process that you're going to make sure that these firms are strictly reviewed before receiving regulatory relief. On that topic, some bankers who I've spoken with are concerned that your staff wants to tailor the regulations or particularly or partially apply them to firms that are not systemically risky. If this is true, which would be somewhat troubling, I think data and evidence should determine the outcome. Can you confirm that firms that don't pose a systemic risk will be exempt from the SIFI regulations?
You know, we're going to do exactly what the bill orders us to do, which is publish a framework for how we're going to think about risk to financial stability and safety and soundness. This is the language of the bill. We're going to put that out as soon as we can possibly get it thought through. We're going to get comment on it, and then we're going to go forward from there. And you know, we very much take to heart the letter and spirit of the bill, and you know, we'll look forward to getting input when we finally propose something. I hope soon.
So, am I right to interpret that we're going to let the data determine the outcome?
We're in the process now of identifying the factors that we'll think about. The bill gives us a lot of flexibility, identifies some factors and gives us other flexibility. We're going to publish a framework that says how we're going to look at activities and institutions below 250, and then we're going to hear back from the world about how we did and how we should think about these things. And it's a process that the statute orders us to undertake, and that's what we're doing.
So is it conceivable that, or maybe it isn't, is it, I guess, possible that you have a regional bank, let's say 150 billion or so, that may have partial regulation of SIFI, or is it going to be either they're systemically risky or not?
Really haven't faced that question yet. We've always tailored, even when the limit was 50, we always tailored the application of the so-called enhanced prudential standards under 165. We tailored those a lot in the prior world, so we'll obviously do that too, and we'll certainly do that, continue to do that.
Okay, and probably don't have time to get into my last question, so I'll submit it to the record, and I'll yield back the rest of my time to maybe allow somebody else get in before the hard time. I yield back, Mr. Chairman.
Gentleman yields back. Chair now recognizes the gentleman from Ohio, Mr. Davidson.
Thank you, Chairman. And Chairman, thanks for your testimony. Thanks for the work you're doing there, and look forward to the Senate giving you some more colleagues soon, hopefully. You've spoken a fair bit about trade. A lot of our colleagues are concerned about trade and the impact that bad trade practices have had on our economy, and frankly, some concern about the tactics that have been employed to engage in that. I wanted to see if I got your quote right. Trade is really the business of Congress, and Congress has delegated some of that to the executive branch. Do you think it would be a positive development from the economy's perspective to have collaboration across the entire cross-section of the economy that Congress represents?
I think, you know, this is really Congress's, the Constitution gives this to you.
Authority.
And you've, over time, delegated some of it to the executive branch, but it's your authority.
Thank you, and we're working to reclaim it with the Global Trade Accountability Act, H.R. 5281, always looking for co-sponsors, and this leaves the authority in the President's hands to negotiate, but similar to the REINS Act, gives authority to Congress to review. And I think it would promote a more collaborative process than Peter Navarro has recommended and, in fact, persuaded folks to implement. Do you think that if we had practices that were more targeted in the effect that we could be able to focus on bad things, then let's just face it the other way. Do you think uniform action across all countries in all sectors is potentially more disruptive to the economy than targeted actions?
You know, as you know, Mr. Davidson, we don't have this authority. This is authority that...
Correct. I'm just asking about the impact on the economy,
macroeconomically.
macroeconomically.
I think on issues like fiscal policy, trade policy, immigration policy that can affect the economy, I think we have a role there because, you know, we're responsible for the economy, but I think we need to stay at a higher level of principle, and you know, and what I'm comfortable saying is that a more protectionist approach to trade, if it's sustained over a period of time, you know, has not historically been good for economies. It's meant lower incomes. It's, you know, less opportunity for workers.
On the economic principle of trade, it's called trade because it's reciprocal in the sense both parties benefit in trade. Do you see trade as a zero-sum game?
No, I do think that trade needs to be fair as well as free, and I think it's very appropriate to have an internationally agreed set of rules, and when anybody breaks those rules, they have to face the other countries, in that setting and change their policies. I think that's a healthy way to go. I don't think a bilateral trade deficit is a good measure of trade between countries, though.
Thank you very much. One of the things we've also dwelled on is workforce participation, and one of the big barriers to the growth rate in the economy is workforce participation. Without alluding to specific policy, and I don't want to put you in that spot, we've tried to make some reforms on bills. Most notably recently the Farm Bill, which is really only about 20% about farming, a very incremental change to expect that working age adults, 18 to 59, able-bodied, no dependent kids at home, not an economically depressed area, a couple other qualifiers, that in order to continue to receive support through food stamps, that they would work. Would this, in your mind, policy tools that motivate people to participate be effective at workforce participation?
And as you know, I can't really take position on that. I will say that there's not a lot that you could do that would be more constructive than find ways to support labor force participation that will work on a bipartisan basis and can be enacted.
Thank you for that.
Important.
Thank you. And so cryptocurrency is a big thing. And so without talking about specific things in our policy, we are working with Basel on a number of fronts. And some concern, we always protect our sovereignty in that. Where do you see Basel going with respect to cryptocurrency? Because essentially the concern there is that even if the U.S. creates a better regulatory framework than we have today, there's still arbitrage in markets. So there's a desire to have some regulatory framework. Is Basel addressing that, particularly with respect to cryptocurrency?
I think, anybody who owns, if a bank owns cryptocurrency, then it'll be subject to capital. It'll have to hold capital against that. I guess a good question is, should it be more than the normal level of capital because it's a risky asset?
Right. So to the extent that it's an asset, it would be treated, if it's a commodity, treated as if it's a commodity. If it's truly a currency, it'd be treated as a currency based on its amount of volatility as a currency. For example, the pound sterling is probably a different reserve currency than the Thai baht.
Yeah, and I don't know that we. So it's not mainly a bank capital issue. Of course, I think the regulatory issues facing cryptocurrencies are big and broad and go way beyond banking. And
Thank you. My time has expired.
Time of the gentleman has expired. The chair will recognize one more member, and then we will dismiss the witness and adjourn. The chair recognizes the gentleman from North Carolina, Mr. Budd.
Thank you, Chairman Hensarling, and Chairman Powell, again, welcome back. It's always good to be with you. We appreciate you being here today. So I want to start off with Volcker. I think a lot of us can at least appreciate the intent behind Volcker, which is to reduce risky activities in banks, in particular high-risk prop trading, and that potentially makes sense. However, it seems to be odd results that under the current rule, activities such as providing capital and loans to growth and startup companies, activities that we should be encouraging banks to engage in, are materially limited as a result of that rule. Your recent NPR is open-ended on covered funds and does not provide a lot of guidance about where the Fed may intend to go. Yet these funds can be critical sources of capital for companies looking to grow their businesses. And the prohibition on funds is fairly broad and even includes restrictions on venture capital funds. So, Chairman Powell, is there a way for the Fed to simplify the covered funds regime to help smaller companies obtain greater access to capital?
And we're looking for ways to simplify Volcker in ways that are faithful to the language and intent of the statute, and that's one particular provision. And we look forward to getting constructive comments on how we may do that better.
So you're just waiting through the NPR period then on that?
Yeah, we're really looking for input here on where this is a notice of proposed rulemaking. We want a lot of input. We do, our job is to implement Congress's wish, and that is the Volcker rule, but we feel like we want to use such flexibility as we have that doesn't undermine safety and soundness, and that there would clearly be some flexibility around the issue you're talking about.
Thank you. I want to switch topics to the ongoing negotiation of a new International Capital Standards, or ICS. First, I want to thank you for such a quick and thorough response to questions that I had after we met last time. We don't always get quick responses, but you did, so thank you. We're genuinely grateful. And the following question, sir, it was originally intended for Vice Chairman Quarles, but a letter he sent back to my office on this question we received just yesterday and chose not to respond to this portion. So hopefully I'll pitch it to you for an answer. And Governor Daniel Tarullo stated in a speech at the National Association of Insurance Commissioners International Insurance Forum, this is on May 20th of 16, he said, quote, "There are, as you all know, a lot of ideas out there as to how we should construct the capital requirements we will apply to insurance companies. Some, such as variations on the Solvency II approach used in the European Union, strike us as unpromising. The valuation frameworks for insurance liabilities adopted in Solvency II differ starkly from U.S. GAAP and may introduce excessive volatility. Such an approach would also be inconsistent with our strong preference for building a predominantly standardized risk-based capital rule that enables comparisons across firms without excessive reliance on internal models. Finally, this is a mouthful, isn't it? Finally, it appears that Solvency II could be quite pro-cyclical. So, do you agree with what Governor Tarullo said there?
It makes sense to me. I have to admit, I don't recall that speech and what issue he was talking about there.
About Solvency II being used by the EU, being pro-cyclical rather than counter-cyclical.
You know, I'd want to check with our insurance capital experts, but yes, I do believe that, I think that reflects our view.
Good. Can you give us any explanation as to why the Federal Reserve staff participating in the Kuala Lumpur negotiations agreed to accede to the Europeans at the IAIS to mandate that the financial reporting for the reference ICS be done using a Solvency II approach, what we just talked about, Solvency II approach, and not something more suitable for the U.S. insurance industry like GAAP or statutory accounting?
Yeah, I'll have to check up on this. I don't have this kind of detail.
Pretty in the weeds, but appreciate you thinking through it, right? And if we could get that back, thank you. And finally, do you agree with Governor Tarullo that a Solvency II accounting approach introduces excessive volatility into the U.S. insurance markets? And if so, how do you plan on remedying this at the next IAIS negotiations on ICS?
I'm really going to have to go back to the office on this one.
We just delve further into these weeds. Well, if we could get a response, it would be great at another time. So thank you so much again for your time. And Mr. Chairman, I yield back.
Thank you.
Thank you.
Gentleman yields back. I'd like to thank Chairman Powell for his testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witness to the chair, which will be forwarded to the witness for his response. I would ask Chairman Powell that you respond as promptly as you are able. This hearing stands adjourned.